London, and here are your top stories. Protests grit China. Demonstrations erupt in cities including Shanghai and Beijing in a rare show of defiance against the government's COVID curbs. Investors flee the unrest, stocks and futures tumble while treasuries and the dollar climb as the turmoil sends a shiver through global markets. Plus, commodities also taking a hit. Iron ore and oil slide amid concern over the strength of China's economy. The Aussie and the Kiwi lead a decline across major currencies. Yes, it is a big day, and most of that focused is on what is happening in China in terms of those protests. Arguably pretty unprecedented to see the scale across multiple different cities unified by one particular issue, which is these anti-COVID sentiments now that you are seeing playing out across those protests in China. The FTSE 100 currently down 0.1%. We continue to watch, of course, what is happening in basic resources and commodities. We'll unpack that story for you in more detail. Of course, the play through to the FTSE 100, where, of course, a heavy lean from some of the big names listed there to those sectors. Currently down 0.4% as well. So what's happening in China? Beijing, Shanghai, other cities, Wuhan as well, Chongqing and Chengdu. You are having protests along and again on a unified issue, anti-lockdown, anti-restrictions, a deep anger about what happened, particularly in Xinjiang as well, and the deaths of at least 10 people there in a fire. The FTSE 100 currently down 0.8%. The Spanish IBEX off by 42 points. Over in France, losses of 0.5%. Let's switch it over and see how things are playing out then on a week as well, where we're expecting to hear from big central bank policymakers, including Christine Lagarde and Jay Powell as well on Wednesday. The S&P futures currently pointing down by 0.6%, holding above that 4,000 line. The Bloomberg Dollar Index is bid in this risk-off environment, up 0.3%. Yields, in fact, Treasuries bid, yields lower, 364 on the benchmark, down by 3 basis points. And Brent, $81 a barrel, just holding up above $80 a barrel, but down 2.7%. That is back to levels we last saw in December. WTI, by the way, comfortably below $80 a barrel. Last time I checked, around $74. Let's switch it over and look at European miners. Of course, the exposure there, particularly when it comes to iron ore. We're looking at Rio Tinto, Glencore and BHP Group down between 1% and 1.8% on concerns about what this all means for China's economy going forward. And there's a divergence within the economists and investors as to what happens. Does this actually, these protests, lead to a speeding up of the relaxation of restrictions, or does it lead to a crackdown and further tightening? Certainly, Nomura have downgraded their forecast for growth for next year down to 4%. So that's the hit on miners. We'll look at what's happening across autos and luxury. Of course, China, a major market for both of those sectors. So the ripple across to what is happening in terms of the corporates in Europe already facing their own challenges around the energy crisis. Now that hit from China just being underscored by what is happening. Volkswagen currently down 0.7%. Mercedes-Benz, of course, part of Daimler Group, down a full 1%. And here the luxury makers, LVMH, off by 0.6%, and Kering off by 0.4%. So again, we're just underscoring for you the linkages between this European economy and the corporates here and the concern about what is happening in China. The other story to focus in on, of course, is what is happening in Apple. The Foxconn plant in Zhengzhou in lockdown, and the hotline, the red head crossing just in the last few minutes, is that Apple will see a hit of about 6 million iPhone Pros as a result of what is happening in Foxconn and its facilities in that city of Zhengzhou in central China. So a big hit there for Apple. We'll monitor as well the other suppliers to Apple, European suppliers, Asian suppliers as well, and see the tie-ins there across this tech sector. Clearly, the exposure of Apple being called into question again, its supply chains impacted by what is happening in terms of the protests in China. Right, let's get over to Bloomberg MLive Managing Editor now, Mark Cudmore. Mark, you've been looking at two charts that give more context to this pessimism around China, and I know you have views as to whether or not that is going to be sustained.
Yes, good morning, Tom. You provided some excellent context there for the uncertainty we've got at the moment, which way we go. You highlighted the fact that Nomura have downgraded their growth forecast by 4% to next year. And that's what I want to talk about, the context of where we're coming from. But before I do, Tom, I must apologize for leaving you hanging there in the Bloomberg Markets Europe. You've never left me hanging, so I felt bad about that. Entirely my mistake. Anyway, let's go look at the 2023 growth forecasts. And this is China line, the white line here. The growth forecasts have fallen in the last 2 months from 5.2% 2 months ago down to 4.83%. But this is where they are for the US, for Europe, and the UK. Europe and UK expected to contract next year. US, 0.4% growth. There's probably downside from here. You talked about Nomura downgrading their growth forecast to 4%. 4%, that's a level that has not been seen, not even been imagined for US, UK, and Europe for next year. I think that's the important context. We talk about how damaging the Chinese growth story. Sure, it's been downgraded, but it's still expected to grow much faster than any Western economies. It's just that it's so important for global trade, it has consequences. One other chart to show that kind of context. Again, we talk about the weakness in the yuan, about what can the Chinese government do about the slump. Here's 1 year implied volatility of the yuan, dollar yuan, 7.2%. You can't even really see the tick up today since the weekend. That's 1 year volatility. The short term's reacted more. Meanwhile, here's 1 year volatility for euro dollar, for dollar yen, and for cable. And the point is, at no point in the past year have we expected dollar yuan to be more volatile than the major G10 currencies. Now that's of course because it's managed, but it's important to have that context here, that the weakness we're talking about in the economy is weakness coming down from great strength and still massive outperformance. And again, when we talk about the currency, it's weakening, the PBOC facing pressure, it's much less pressure than Western currencies face all the time.
As ever, always fantastic context. You didn't leave me hanging, you were just keeping me on my toes, Mark. I understand that this Monday morning. It was appreciated. MLive Managing Editor Mark Cudmore. Currently the yuan down 0.5%, trading at 7.20. Now, let's get to that story, the details, of course, and the reporting on the ground. Protests against COVID controls have spread across China as citizens frustrated by the strict rules took to the streets over the weekend. Some protesters in Shanghai even called on President Xi Jinping to step down. It's a level of dissent unheard of since he took power a decade ago. For more, Bloomberg's Martin Ritchie joins us from Shanghai. Martin, you were at the protests. What have you been seeing on the ground?
Yeah, that's right, Tom. There were pretty unprecedented scenes. I was in the region of the protests last night, Sunday evening, in an area where normally on a Sunday evening, very placid, lots of little wine bars, little noodle bars, normally pretty quiet. But last night, thousands of people had converged on this area to protest against COVID restrictions. There were hundreds of police also bussed in. At times, the protesters would give sort of sarcastic applause to the police kind of trooping out of the vans. There was a lot of protesters sort of been picked off from the crowd, and the police gradually tried to disperse the crowd down various side streets away from the main location. Never seen anything like this in the more than a decade I've been in Shanghai. It really is a very unusual scene to see such protests out in the open. The crowd were, I would say, predominantly, a rough guess, more than half very young people under the age of 30. And one thing that we've reported on already was the sort of very significant presence of young women in the crowds as well.
Yeah, it's really interesting, Martin. You have the context. You've been on the ground for a long time. I was there for a little over 5.5 years. I mean, it isn't unprecedented. It isn't particularly surprising to see sporadic protests across China, usually focused on localized issues. The point here is that you're seeing multiple cities, a unified issue, and it's all happening at the same time, and that makes it pretty unprecedented, as you say. What are the protesters, though, calling for? How much uniformity is there around their set of demands?
I honestly wouldn't go as far as saying we're talking about a set of demands. I'd just like to roll back and be a little bit specific about what they're protesting about. There was a large fire in an apartment complex in Xinjiang, right in the west of China, very far away from Shanghai, that claimed some lives, and a lot of people were angry because this appeared to be somewhat linked to COVID restrictions, allegedly. So this became a sort of flashpoint across China for complaints about sort of overzealous COVID policy. We've had 3 years of very tough restrictions. The first 2 meant that China was the safest place in the world. But this year has become very difficult, very unpredictable restrictions, curbs on daily life. We obviously had the big lockdown in Shanghai earlier this year. That's been repeated across the country in various cities. And, we're going through a wave of cases at the moment and seeing lots more curbs on people's lives. And I think there's just a level of tiredness, especially among the young population, when the economy is also slowing.
Yeah, Martin Ritchie, excellent reporting. Thank you. On the ground for us in Shanghai. He was at those protests, monitoring those protests for us last night. Thank you. Joining us now is Jacob Mitchell, Chief Investment Officer at Antipodes Partners. Jacob, we saw Wall Street. Good morning. Thank you for coming to the studio. We saw a number of big names on Wall Street. It's Goldman Sachs, Citi, others saying a few weeks ago, now is the time to increase your exposure, turning more bullish on Chinese equities. Were they premature?
Look, I think when you look forward 6 to 12 months, China does look like, and probably these protests make it even more urgent to find a way to reopen the economy. It's a difficult choice that they have to make because of previous policies probably been less than optimal, but they understand that more than ever, given where youth unemployment is in the economy, they need to get China policy refocused on growth. And I think being constructive now is not a crazy idea. I mean, if you think about the U-turn on property policy, it's been a 180-degree U-turn from being very, very tight to being actually quite loose. So I think that probably, in terms of the pathway of the economy, the amount of stimulus reaching the economy is important, and that's certainly going up a notch.
Yeah, so on the youth unemployment, about 20%, which is remarkable, 20% youth unemployment. And then you did have, in terms of the stimulus, reserve ratios were cut, or at least they will be. It was announced they're going to be cut on Friday. That will come through early December. So in terms of that policy support, is it going too far to say that you would position to take advantage of the dip that we're seeing today?
Look, I think in the short term, you may see continued volatility. This, as you say, these sorts of expressions of dissent, dissatisfaction are very rare in China. And I think it'd be wise to see how that plays out in the short term. But to be constructive on the 12-month view, I think is right.
How concerned are you about the trajectory in terms of the growth picture? And how effective can that stimulus and that support be, whether it's cuts to the reserve ratio or loosening the lending requirements between banks and those property developers? And you talked about real estate. When so much of the economy is locked down or restricted, how effective can those measures actually be?
Sure, that has been an issue. But I think the way that COVID policy is interpreted in China at a local level is always difficult, changing. You could argue there's been a softening in the way policy is implemented. So I think trying to read those tea leaves is very, very difficult as an investor. Yeah. But I think the trajectory is more, it's more about a mind share shift, I think, towards it's the economy that matters. And I think these protests probably highlight the urgency of refocusing on a growth policy as opposed to, let's call it, the reform policy that we've had for the last couple of years.
And I know you look at the geopolitics as well, so this is a bit of a broader based question, but there is an argument as well that this just reminds everyone, investors and those looking at the geopolitics of the region, that China has so many domestic issues that the idea that it's going to go after Taiwan in the short term is nonsensical.
Look, we would sort of take that view that it's the idea of a hot war in Taiwan is very, very low probability, for all sorts of different reasons. But it doesn't mean that geopolitically the US and China will continue to compete. And I think that throws up opportunities. It's more of a multipolar world that we live in, and other EMs will benefit from that competition.
Okay, I want to shift focus to what's happening with central banks. So we have Jay Powell going to be speaking on Wednesday. Do you expect the Fed governor to push back on some of the loosening that we've seen in terms of financial conditioning? We've heard from other officials suggesting 50 basis points is on the cards in December. It's this very tricky balancing act, isn't it, between wanting to edge those rates lower, but also remain and continue to see financial conditions tighten.
Exactly. I think the market's sort of in this mindset of trying to front run the so-called the pause. I think for that sort of positioning to really work, you need to see a loosening in the labour market very soon. You'd be looking for a negative surprise in this month's employment report. The longer the labour market stays tight, even with declining inflation, mathematically inflation has to decline. But if employment stays relatively tight, I think the idea of a pause is premature, and that rally could fade, and then we start to focus on next year and what S&P earnings are actually where they're going to actually land in a tougher economic environment.
Yeah, and you've noticed some derating within US equities. You don't like the broad buy. You wouldn't just buy the index, would you? But you have seen some derating. So where are you seeing opportunities then within US equities at this point?
Yeah, look, the US is, as you know, such a diverse market, and you've had derating across global equities. It's been a long while. Ex-US equities have traded on quite a large discount. I think in the US, it's looking for the beneficiaries of longer-term investment trends. You see, the euphemistically labelled Inflation Reduction Act, which could be more accurately described as the Inflation Reacceleration Act, given it really focuses on a very large subsidy to renewable investment. The beneficiaries of that investment, they're not just US companies. They're industrial companies that are going to be selling into the electrification trend. I mean, that's where we're hunting. Also in some of the lower multiple parts of the market where you are seeing relatively good growth, the pharma stocks, everyone likes to rent them as defensives. We're pretty constructive on them as, let's call it, reasonable growth profiles in the companies like Merck, Gilead. You're on low double-digit multiples for, let's call it, high single-digit, low double-digit growth, which is pretty reasonable.
Okay, so looking possibly to increase exposure to pharmaceuticals, they hold up well within this environment. And I know as well you're looking longer term when it comes to the question of China. 6 months, 12 months down the line, the picture is going to look slightly brighter. That is the call from Jacob Mitchell, Chief Investment Officer at Antipodes Partners. Thank you for coming in this morning. Coming up, oil in focus as WTI drops to its lowest level since December. We're going to get more on that next. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen. These are solutions to not just climate issues, but geopolitical issues.
We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. We are 18 minutes into the European trading day. Is risk off the European benchmark, currently down 0.3%. Of course, a lot of that tied to what is happening in China. And the unrest in China has also affected oil, which has tumbled to the lowest level since December. WTI sank below $74 a barrel, following 3 weeks of losses. For more on this, let's bring in Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. So let's start with the question is why the oil market is selling off so much on the back of, yes, they are pretty unprecedented protests, but does it really change the dynamic in China? Why the sell-off and so dramatic?
Yeah, I think the ultimate impact of these events are very hard to read for the oil market, because what we don't know is whether ultimately it will open the Chinese economy more quickly, which would, in the end, be bullish for oil. I think it's creating a risk-off sentiment, and I think that people have been quite wary of oil for the last few weeks, and this gives them another reason to be wary of oil. The market looks fairly well supplied. This is coming against the background of discussions about the Russian oil cap and forthcoming sanctions, but right now people think that the flow of Russian oil will be maintained. And you put that China uncertainty on the demand side together with what looks like fairly healthy supply, and you've got a pretty weak market.
It makes that, arguably, it makes that decision by OPEC Plus to cut output look pretty rational at this point. And they have their next meeting this weekend. What are you going to be looking for there?
You make a good point. Without the cut, I think oil might be even lower right now. And clearly, I think with hindsight, the decision that the Saudis and their allies took probably looks the right one from their point of view, despite the huge criticism they took from Washington and elsewhere. Going into this weekend's meeting, I think the base case remains that they roll over production, but looking at these lower prices, I think that people should be thinking whether they're going to discuss a cut. We don't have any reporting to suggest that that's on the cards, but when the Saudis put out a statement last week denying a story about a raise, it was quite notable that they gave themselves room to cut again. So I think that's going to be the focus of attention as we go into that meeting next weekend.
Yeah, it was a very strong statement, and they look at Brent at $81 a barrel, WTI at 73, is now below $74 a barrel on WTI. Then maybe it changes that calculus. Will Kennedy, thank you very much indeed. Of course, the lead on energy and commodities here at Bloomberg. Coming up, street protests in Shanghai and Beijing, then as Chinese citizens run out of patience with strict COVID curbs. We're going to bring you updates, of course, throughout the show, what it means for the economy of China, for the society of China, and of course, for these markets. Stay with us. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Welcome back to the Open. 24 minutes into the European trading day. Risk off here in Europe. You're seeing losses of 0.2% across the benchmark. Of course, the handover from Asia, where you saw the benchmark MSCI Asia Pacific down 0.8%, but the selling more pronounced on the mainland in China and also in Hong Kong as well. The Hang Seng currently down around 1.6% on the back of those protests and concerns about China's economy. Let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Thanks, Tom. The government of the Bahamas has criticized the person in charge of restructuring crypto exchange FTX. Attorney General Ryan Pinder says statements made in U.S. bankruptcy proceedings by John J. Ray were, quote, regrettable and misrepresented actions taken by his nation's securities watchdog. The comments are the latest salvo in an escalating fight over the FTX collapse. China Evergrande Group says it expects to receive restructuring support from offshore creditors by late February. The statement came as Hong Kong's High Court accepted the company's plea to adjourn a winding up case until March the 20th. Evergrande is the world's most indebted developer with more than $270 billion of liabilities. Elon Musk says Twitter is now hiring. The owner of the social media company tweeted a slide from a company talk with the words, "We're recruiting," but without any further details. This is a dramatic restructuring which saw the firm's headcount slashed by half. Musk says new user signups have been at an all-time high. That's the Bloomberg Business Flash. Tom.
All right, here in London, thank you very much indeed. Let's check in on some of the movers for you this morning, then some of the companies that jump out to us given what is happening in China, and some idiosyncratic stories as well around a troubled real estate company in Germany. That's Adler Group, currently up 62%, as you can see. Some of its troubles being put to one side after it agreed a deal with bondholders, meaning that it's going to get access to secured debt financing of close to €1 billion, investors rewarding that news for Adler Group. Rio Tinto down 0.9%. This ties into the China story. Concerns, of course, about the growth trajectory of that country as we look at those protests rippling across the country. Record high rates of COVID restrictions as well, and COVID levels. Nomura downgrading their growth outlook for that country to 4% next year, currently down 0.9%. BP also taking a hit. Oil prices, yes, they are lower. The dollar is up. BP down 2%. Again, the oil story tying to China. Brent currently down over 2.5%. Coming up, we're going to talk to Citigroup Head of Emerging Markets Economics, David Lubin, about the China process, the impact on EM. Stay with us for that conversation. This is Bloomberg.
These floating flowers are made of 92,000 solar panels. Laid on the surface of a reservoir, they can generate 41 megawatts, which is enough to power 20,000 homes. It's one of the biggest floating solar plants in the world. Floating solar arrays have been gaining traction in Asia, including countries like Singapore and Thailand. Floating projects typically benefit from an easier connection to the power grid. They can also restrict algae blooms while keeping the solar panels cool. This one in particular has helped the local economy. When the power plant was first proposed, residents were given the chance to invest. Some locals were also offered jobs during construction. In fact, it was the community that requested the panels to be shaped as flowers to look more appealing. South Korea still relies heavily on imported fossil fuels, but will need to change that to reach its goal of becoming carbon neutral by 2050. Solar plants like this one may help the country reach its net zero goals.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Welcome back to the Open. We are 30 minutes into the European trading day. Here are your top stories. Protests grip China. Demonstrations erupt in cities including Shanghai and Beijing in a rare show of defiance against the government's COVID curbs. European markets begin to claw back some of the early losses this session following a drop in Chinese indices and US futures as the turmoil sends a shiver through global markets. Let's check in then on these indexes. Yes, the European benchmark currently down around 0.2%, and it has paired those heavier losses. 0.2% down, 1 basis point. The DAX is off by 34 points, trading at 14,500, just holding above that 14,500 level. The FTSE 100 taking a hit as well, of course, because of the basket in terms of basic resources, the energy companies and the miners, the likes of Rio Tinto and BP and others taking a hit from those concerns around China. Down 0.4%, off 33 points, trading at 7,452 on the FTSE 100. We'll look at the sectors as well to see how the breakdown is playing out, because you did have that focus again on what is happening around energy. You can see that's bottom of the list now as a sector down 1.7%. Basic resources down 0.9%. It's the second biggest loser in your sectors. Just 4 sectors currently in the green, led by healthcare up 0.4%. This is tied, particularly basic resources and oil, of course, to what is happening in China. And those protests against COVID controls have spread across that nation. That's as citizens frustrated by the strict rules took to the streets over the weekend. Some protesters in Shanghai even called on President Xi Jinping to step down. That is a level of dissent unheard of since he took power a decade ago. For more, Bloomberg's Martin Ritchie joins us from Shanghai, and Martin was at the protests last night. Martin, just get us up to date on what the mood is on the ground and what you saw when you were in and at those protests.
Yes, Tom, as you said, these are very unprecedented scenes in Shanghai. I was at the protests on Sunday night around the scene of where the protesters were gathering. It's normally a very placid, tree-lined environment, some wine bars, noodle bars, pretty quiet for a Sunday evening. But yesterday night, thousands of protesters converged on the area, along with many hundreds of police. People gathered initially at one intersection where there had been also a protest on Saturday night, but the police were perhaps a little bit more prepared this time. They dispersed the protesters from that point, pushing them down the side streets. A lot of shouting and exchanges of insults from both sides. Some people being grabbed from the crowd by the police and been taken away. Someone that I know personally, Ed Lawrence, a BBC reporter, was taken away, allegedly beaten as well. Another reporter we know was detained. So it was a very intense scene that lasted well into the evening. And as you said, it's not a scene we see. It's not a scene I've seen in Shanghai in the more than a decade that I've been here. Quite unprecedented.
Martin Ritchie, important reporting for us on the ground. Thank you. In Shanghai. A couple of lines crossing when it comes to the ECB now from Klaas Knot. Of course, he's known to be on the hawkish end of the spectrum, saying that there needs to be weaker growth for inflation to return to goal. You're seeing the euro currently at 1.04, so that's a gain of 0.2% for the single currency. A couple of other lines then from the ECB's Knot, and we are expecting to hear from Madame Christine Lagarde later today. Knot saying that the underlying inflation trends are worrisome. Risks to inflation forecast are entirely tilted to the upside from Klaas Knot of the ECB. Right, let's get back to what is happening across EM and the role that China is playing in that now. And bringing David Lubin, Head of Emerging Markets Economics at Citigroup, someone who has deep experience in covering EM, particularly the money flows between EM and developed markets. David, thank you for joining us in the studio. How much of a sustained potential headwind could what's happening in China be for the broader EM space?
Well, I mean, obviously we need to see how the protests and the government's response to the protests evolve. In the short term, I think it's worth remembering that the excitement that many market participants had on the 11th of November when the National Health Commission issued that statement outlining 20 measures to optimize the government's treatment of the spread of COVID, it's important to remember that they were very clear at that point that this was not a relaxation of control. And so I think any expectation that there should be an immediate relaxation of the COVID controls was misplaced. And in a way, arguably, the short-term implication of the protests at the weekend is to reinforce that view that actually it's less likely in the short run that the government's going to loosen anything, but it may, in the medium term, slightly increase the probability that the government's response in 2023 will be some form of relaxation of the COVID controls, because the protest movement over the weekend shows how deep the anger and frustration is across many Chinese cities and many Chinese communities.
So maybe the time frame is accelerated, and Goldman Sachs made that point this morning in terms of bringing forward. They're saying maybe there's a 30% chance that relaxation, or at least COVID zero measures, start to be relaxed earlier than they had earlier predicted.
Actually, I'm not so sure that that's the case. I think in a way it's more that maybe the second half of 2023. There's a more, slightly higher probability that the COVID measures will be relaxed. And in a way, that kind of substantiates our slightly higher than consensus forecast for Chinese growth next year of about 5.5%.
Given China's central role in demand for commodities that so much of the EM space is responsible for, how has this affected the EM space as you combine it with what's happening broadly as well with monetary tightening? Those combined effects of a China that's been largely sealed off from the world. Yes, it's still sucking commodities, but at a lower rate than if it had been fully open, combined with tighter financial conditions broadly, globally.
Yes, exactly. So around the 11th of November, we had these two kind of positive shocks. One was that set of announcements from the Chinese government, the 20 measures that were supposed to optimize the control of COVID, the 16 measures that were announced to support property market. So we had good news from China, but we also had the October CPI print from the United States. And so you had a kind of inkling for investors in EM of the best combination. In other words, loosening US monetary conditions plus accelerating growth in China. I think the events of the weekend should make us a little nervous about the short-term growth story in China, and we'll have to wait until the 13th of December when we get the November CPI print from the United States to see what the shape of US monetary conditions is then. But our view is that the inflation problem in the United States is not yet fully addressed, and that Fed funds is going to be approaching 5.5% in the first half of next year. And so in the next few months, I think the sort of good news that we've had over the last few weeks, in other words, loosening US monetary conditions and optimism about China, that good news should be undermined in the short term, because I think we're going to see a renewed strengthening of the dollar, renewed increase in US rates as the market gets another negative shock about US inflation. And I think we're going to have to wait until well into 2023 to have some proper grounds for confidence about the Chinese economy.
And having, on the US dollar, having seen some pretty substantial sustained losses over the last few weeks, it's now actually range bound. Earlier this morning, the dollar was getting a bid. Is it your view then that calls for peak dollar are overdone at this point, or at least premature?
Well, we think that the dollar will resume its strengthening path and go back below parity in the near term. But, further out into 2023, as the US gets closer to recession, as the Fed gets, closer to its peak tightening, then at that point you get a more meaningful weakening of the dollar.
We're talking a lot about the recession risks in Europe, recession risks here in the UK, and the assessment that we're already in a recession here in the UK, and of course the US as well. What is the resilience of EM economies, and where is recession concern most acute?
Not that resilient, unfortunately. Korea, Hungary, Poland, Turkey, the Czech Republic, Brazil, Argentina, Vietnam, Mexico, these are all countries that are going to have a technical recession between now and the end of 2023. So domestic demand collapses are going to be quite evident. Of course, that's in a way the obvious consequence of the monetary tightening that many emerging market central banks have been conducting since last year. But it's also the consequence of the fact that, the external demand environment going into 2023, growth in the Eurozone, growth in the United States, growth in China will be relatively constrained. And so developing countries that normally rely on strong trade growth to be able to be optimistic about their own economic performance, developing countries have little to be confident in terms of the external environment that they face.
What does that tell us then about debt servicing risks? This is a focus for many who look at the EM space, and to what extent that vulnerability has been addressed in some of these nations. Are debt servicing costs becoming acutely painful for some of these countries? Is there a debt risk that we're not looking at yet?
Not a systemic one. I think it's worth making a distinction here between sort of middle-income developing countries and lower-income developing countries. And I think it's low-income developing countries, countries that have sovereign credit ratings of single B or below, that have the greatest risk of debt payments disruption. But even then, going into 2023, there aren't that many low-income emerging economies that have huge amortizations of external debt. So the pressure is there. But if the dollar starts to weaken, if U.S. rates start to decline in the second half of 2023, it's possible that we could avoid the crisis spreading too much. But in any case, it's worth bearing in mind that a debt problem that spreads across low-income developing countries in sub-Saharan Africa, for example, is not going to present any systemic threat to the global economy.
Okay, really fantastic insights on the EM space for us on this important day when we focus on the impact of China, of course, as well as monetary policy. David Lubin, thank you very much indeed for coming to the studio this Monday morning, head of emerging markets economics at Citigroup. Coming up, we're going to dig deeper into the China protests then with Steve Tung, director of the SOAS China Institute at the University of London. Really important perspective then from Professor Tung coming up. Stay with us for that interview. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing? When I think about the metaverse, I think about sort of experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
No one covers covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Welcome back to the Open. We are 44 minutes into the European trading day. A volatile day for European stocks, having pared some of the heavier losses. European stocks have now taken a leg lower, currently down 0.5% on the benchmark. The euro has strengthened by 0.3%, euro-dollar, on the back of some seemingly more hawkish comments from ECB officials. Glassnot saying that strong demand is to affect inflation, and saying that we need weaker growth for inflation to return to the ECB's goal. Now, returning to the big story of this morning, out of China, where protests against COVID-0 have spread to multiple cities. For more on this, in terms of the analysis and the context, let's bring in Professor Steve Tung, who's the director of the SOAS China Institute. Professor, thank you for joining us this morning. And I do want to start, before we get to the here and now, the protests, just if you could put this into historical perspective for us, the significance of what we're seeing unfold in China right now.
Well, what is significant over the weekend was...
Okay, Professor, we're having some audio issues, so we're going to try to amend those issues because we couldn't hear you very clearly. We absolutely want to get your analysis and your thoughts on this story, of course. That's Professor Steve Tung. We'll try to get the line back up. This is someone who, of course, has studied China, the politics of China, very, very closely over very many years. And, of course, this is at a time when we are assessing what is happening. The protests in Shanghai, the protests in Beijing, and other cities across China. And, again, it is not rare, particularly rare, to see protests in China. What is rare is to see protests where there is a unified message across so many cities happening at the same time. And in the case of Shanghai, seeing some of the protesters there calling for the stepping down, or for Xi Jinping to step down, that is pretty remarkable as well. We'll try and get an analysis from Professor Steve Tung shortly. For now, let's bring in the Bloomberg First Word News with Laura Wright. Laura.
Thanks, Tom. European Union diplomats are expected to resume talks later today on capping Russian oil prices. Poland and the Baltic states are unhappy at a proposal they considered too generous to Moscow. A senior diplomat says Poland wants additional sanctions, as well as a review mechanism and a price below the market level. Taiwan's ruling Democratic Progressive Party has suffered its worst ever showing in local elections, with the opposition gaining power in the capital, Taipei. Taiwan's president quit as DPP party leader after the losses, which came amid rising disquiet over cost of living issues and an uptick in COVID deaths. UK Prime Minister Rishi Sunak is facing pressure to drop a ban on new onshore wind farms. Sunak's predecessors, Boris Johnson and Liz Truss, are among a group of Conservative lawmakers backing a pro-wind amendment in Parliament. It's the second rebellion on the same legislation in less than a week after the government pulled a vote on its house-building plans. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
Laura, thank you very much indeed. Coming up, European markets in the red following the drop in Asian equities, ripple effects from the protests in China being felt across the world. The Apple story as well, important, seeing a 6 million iPhone hit from the disruption in Zhengzhou, where their Foxconn factory is based. We're going to wrap up the Open next and get the analysis across these market themes. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
Welcome back to the Open. 50 minutes into the European trading day, seeing losses of 0.6% across the benchmark, tied to concern about what is happening in China. For more on that topic, let's bring in Steve Tung, Professor T. Tung, Director of the SOAS China Institute. Professor, how much of a tipping point is this, a tipping point for China that we're witnessing now?
There is not yet a tipping point, but if the protests were allowed to continue and spread, then we may well reach a tipping point. And Xi Jinping has made it very clear the year after he became leader of China 10 years ago in 2012, that he would not make the mistake that the Communist Party of the Soviet Union made when there were dissents within the party. So I think the likelihood is that Xi Jinping will act very strongly against the protesters who were directing their protests against him and the Communist Party, and put an end to the protests with whatever means necessary in the next few days.
Okay, so you're in little doubt that the authorities led by Xi Jinping will put an end to these protests. What about the COVID-0 restrictions? Do you have any more clarity on how the government is likely to adjust those in the months ahead?
Well, the zero COVID policy remains the policy in place. It is possible that once Xi Jinping has, if you like, restored order, that he might consider making some adjustments to the policy in order to remove some of the underlying causes for the protest. But he will not do that before he can restore order, because then it will be a sign of weakness. And as a strongman, perhaps dictator of China, he simply cannot afford to appear to be weak at all.
Does the resentment, does the anger that we're seeing bubbling over in cities like Shanghai, like Beijing, does it crystallize into something else? It was remarkable to hear the chants of Xi Jinping, step down, Xi Jinping, amongst those Shanghai protesters. Even if the protests are put down as you expect, does it crystallize into something else in the months and years ahead in terms of a more direct challenge to the CCP?
Well, and that is exactly why I think Xi Jinping will act and suppress it, because he would be worried that if the protests in Shanghai, or starting in Shanghai, were allowed to continue, then it will crystallize into something bigger, and there could be a movement nationwide to question the authority of the Communist parties to stay in power, or for Xi Jinping to stay on beyond his 10 years rule. And that is why I really don't see him showing weakness on this occasion.
Professor, is it also arguably a reminder of the huge domestic challenges that China faces, and maybe calls into question some of the hand-wringing, some of the angst about the geopolitical risks that China poses? I'm thinking particularly of Taiwan. Can they afford to even consider Taiwan as they wrestle with these huge domestic challenges?
Well, the domestic challenges are huge. in the best of time, in the last 10 years, they are significant challenges. But the way how Xi Jinping handled them, in fact, make the problems much worse. The pandemic was a global problem that everybody had to confront, and it was challenging in many, many different parts of the world. But it is Xi Jinping's insistence that the zero COVID policy demonstrates the superiority of the Communist Party system that make it into the kind of situations we found in China today. Now, whether Xi Jinping will take on Taiwan, I think it will be more a matter that if he feels that there is a need to show unity of China and to have something to get people in China all unite behind him, then he will probably pick on Taiwan. So I think the weakness that are being revealed in the systems in China today slightly increases the chance of him taking a risk over Taiwan than reducing the risk because he needs to focus on domestic policies.
Very, very interesting analysis. We appreciate your time. Professor Steve Tsang, Director of the SOAS China Institute, on the protests, the context, the implications for the CCP and Xi Jinping. Right, we're almost an hour into today's session here in Europe. For more, let's get to Bloomberg's global equities reporter, JP Barnett. JP, what are you watching?
Well, we're of course also watching the China story. We're also already seeing ripple effects going through the European market with retailers going down, automakers going down this morning. We saw Apple shares going down about like 1.9% at one point this morning about the news on disruptions on one of their production facilities, which might cause 6 million less iPhones being produced. So all those things are not playing well for the equity market right now, especially as we are at a very high point after that amazing rally over the last couple of weeks. And the market is desperate for some good news from the fundamental side, and we are not getting this at this point.
The fundamental news is lacking. We're having some central bank speak as well. Jay Powell later this week, Madame Lagarde today. How much of a dial, and to what extent could they move the dial on this market?
They are definitely still important, but my feeling is like after the inflation rally that we have seen over the last couple of weeks, that the market has celebrated peak inflation, and that topic is kind of digested. And there is a danger now that the market maybe is turning to another issue, and this is recession, and that the focus for 2023 is shifting on that topic. So I'm not sure if the central bank comments will play the major role this week.
Yeah, we heard from the ECB's Klaas Knot saying we need to be in a recessionary environment in order to get inflation back down to target. Bloomberg's JP Barnett, as always, excellent on these key market themes. That is it for the European Market Open. Surveillance Early Edition is up next. Your markets here in Europe, a leg lower, down 0.5%. Futures stateside also pointing lower by about 0.5%. Risk off on concerns around China. Stay with us. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Happy Monday. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Protests grip China. Demonstrations erupt in cities, including Shanghai and Beijing, in a rare show of defiance against the government's COVID curbs. European markets follow Chinese indices and U.S. futures into the red as the turmoil sends a shiver through global markets. Let's check in on those markets because it really is that one story that is dominating risk appetite, and risk appetite, there is little this morning. It's really the uncertainty of not just the protests, but what it means for COVID restrictions. Could they be more harsh? Now, some of the worst of the selling, we have backed off of that. S&P 500 futures down about 0.5%. Light trading last week, given it was a holiday week, but we did see Asia stocks, specifically Chinese equities, see their worst fall in about a month. Now, alongside equities falling, you did have some buying coming into treasuries, so lower yields plus a lower dollar did mean that at the moment we're seeing the Japanese yen appreciate by more than 1%. It is on track for its biggest monthly appreciation since 1998. So the China demand for haven story feeding into the peak yield, peak inflation, peak hawkishness narrative. But adding into that disinflationary narrative is NYMEX crude. It has done a round trip. US WTI crude is now at its lowest level since December 2021, wiping out all of the gains for this year. Now, along with that China story, one of the other folds in this has been the lockdown, some of the restrictions around that Foxconn factory, trying to lure in more workers with bigger pay. According to people familiar, the Apple iPhone Pro will see about 6 million iPhone Pros close a shortfall, rather, of production of that specific model. So Apple pre-market just opening down 1.2%. The wider European context, basically every single regional benchmark is down this morning. Taking another leg lower after Klaus Knot of the ECB, a bit of hawkishness coming from him this morning, saying that, look, inflation risk is almost entirely to the upside, and they need to get inflation down. They need to get growth down in order to get inflation down. So let me show you what the European map looks like. Basically, everything is down, and it's being led lower by energy, the worst performing sector. Don't have that for you in the moment. We'll bring it to you later. But there you go. TV magic. UK stocks, those are down about 0.7%, one of the worst performing, again, because it is energy and materials that are the worst hit this morning. Let's continue with that story. In China, protests against COVID controls have spread across the region as citizens frustrated by strict rules took to the streets over the weekend. Some protesters in Shanghai even called on President Xi Jinping to step down, a level of dissent unheard of since she took power a decade ago. We're joined now by Luigi Speranza, Global Chief Economist of BNP Paribas Markets 360 Division, along with Bloomberg's Greater China Executive Editor John Liu. John, let me start with you. Can you put these protests in the wider historical context and just in the context of the moment?
These protests are pretty unprecedented in the sense that public displays of opposition to government policy is very rare in China. It does happen from time to time. I've been in Beijing for 12 years, and this is the first time I've seen anti-government protests of this scale here in this city. And again, you've had them in Shanghai, you've had them in Chengdu, you've had them in Wuhan and other cities across the country on varying scales. In Beijing, we're talking about a few hundred, maybe upwards of 1,000 people. In Shanghai, several thousands. In other places, much smaller than that. And so it does speak to the frustration, the fatigue that people are going through when it comes to COVID restrictions. And of course, this all being sparked off by that fire in Xinjiang late last week that killed 10 people. The protesters saying that the COVID restrictions, or suspecting the COVID restrictions, delayed firefighters being able to get to that blaze and putting it out.
So John, what are we hearing from the protesters themselves? Yes, it might be in reaction to the fire, but are they calling, for example, for an end to COVID-0? What are we sort of hearing on the ground?
The protesters are calling for an end to COVID-0, for no more tests, for no more restrictions. I think they represent a relatively more extreme slice of the population, obviously. You've seen much more across Beijing, for example, different neighborhoods across the city, neighbors getting together, opposing local government officials trying to lock down their apartment complexes, arguing that it's not a scientific way to try and stop infections. There are a lot more people who are opposed to the strict lockdowns that force people to stay home, the use of chains and bolts to close doors so that they cannot be opened. The fact that they are a safety risk if there were a fire, for instance, that's much more widespread. A little bit more extreme is this call for an end to every sort of restriction when it comes to COVID.
Luigi, let me bring you into the conversation. So that's the color on the ground that John just gave us. What are your concerns when it comes to these protests and the impact of it on Greater China?
Yeah, I think the key issue here is that they are not likely to change the stance of the government when it comes to the COVID-19 policy, at least in the near term. The measures have been just announced only recently. Will take time to assess their implications. So in the short term, it's bad news for the economy. Higher uncertainty, concern, the government might go hard in terms of reactions. And protests could also lead to new supply constraints emerging and likely to be associated with weaker consumption. Now, as we move into the future,
yes, continue, Luigi. What happens as we move into the future?
The public outcry supports the view of a continued relaxation in the COVID rules, albeit in a gradual fashion. Will be very much the case of two steps forwards, one step back. But the bottom line, I think, is that the economy is not bottoming out yet. The markets will be concerned in the short term. We continue to expect a turnaround in the spring next year as measures get gradually relaxed.
John, you know, in reaction to what we've seen in China over the past 2 years to COVID, the measures have really been focused on industry. Have there been any rumblings of potential economic measures for the individual?
There have been some efforts taken at that. There have been tax cuts across the country. There's been some talk among economists that maybe what China should do is something more akin to what's been taking place in some countries in the West, directly handing out money to the individual. We've not seen any serious move in that direction. Again, the government here is quite stretched when it comes to the fiscal budget. All of the testing that's been done, all of the building of the temporary hospitals. And also we have this property crisis that's been unfolding for the last few years, and that's really sapped the revenue coming into the budgets of the local governments and the central government.
Mm. Well, Luigi, you know, we've seen things, for example, like the PBOC reducing reserve requirement ratios for the second time, injecting more liquidity into the economy. John was laying out some of the other measures there as well. But Luigi, what does it really do to help growth in China if, again, the issue at the moment is demand for liquidity, not necessarily liquidity itself, but just the demand side of the picture?
Absolutely. I mean, in these circumstances, you know, policy accommodation is a bit pushing on a string. Effectively, I think the fundamental problem is really the COVID-19 rules. The expectation here is that as they are relaxed, that policy accommodation might have a significant impact at a later stage, which is what we're looking for in 2023, a turning requires further relaxation in the measures. Until they are in place, I think monetary policy accommodation is not that effective.
But Luigi, I look at sort of maybe a bit of a false dichotomy, but the scale here of either letting the virus spread or imposing tougher restrictions, it does seem neither is particularly good for growth in the short term.
Absolutely. That's the key dilemma the authorities are facing at the moment. I think here the whole point is to increase the level of vaccination in order to allow greater relaxation at the later stage. That's our expectation. But in the short term, you find yourself between a rock and a hard place.
And just seeing a headline coming through our team flagging that Beijing vowing to curb rapid growth in COVID cases. John, this, of course, comes as we've gotten some sort of measures of more targeted approach, one that helps to allow the economy to grow at the moment. How difficult is that considering growth in COVID cases, or how much have we seen COVID cases pick up at the moment throughout China?
COVID cases are at a record high here in Beijing and across the country. And partly contributing to that, I mean, obviously, the new Omicron variant is far more transmissible than the earlier variants. It's wintertime as well. But also contributing to that is China was trying to loosen, trying to give more space to the economy. And that's unfortunately, I think, also helped push up the number of infections. The point, though, is that the country is still committed, as we've seen high-level officials repeat many times over, to getting infections to zero. And as long as that remains the ultimate goal, I think, unfortunately, they're going to have to resort to testing, to lockdowns, and these sorts of things to get there.
Luigi, what do you make, given that we have Goldman Sachs, for example, seeing a 30% chance that China reopens before the second quarter of 2023? Would you pin the odds at something similar?
Our long-term view has been that the process would be very gradual, but by spring next year we can see significant changes cumulatively that would allow the economy to turn the corner.
Okay, and what exactly would that look like? What sort of pace, what sort of timeline are you expecting?
I think the spring, weather also, better weather, helps there. So we look at the spring as a turning point. Again, a gradual process, but with more effective implications after the spring, with a turnaround in the economy, which would mean still super growth for a very long period, and certainly a kind of a negative outlook in the short term, as you were mentioning.
Yeah, and again, sort of these two opposing forces that China needs to weigh. I mentioned that line about them curbing rapid growth in COVID cases. Another line coming from an official that Beijing vows to reduce the impact of COVID on the economy to a minimum. So certainly a nuanced picture. John, thank you so much for joining us. John Liu, our executive editor for Greater China in Beijing. Luigi Esperanza, chief global economist of BNP Paribas Market 360 division. Thank you so much for joining us. Now, coming up, oil in focus as WTI drops to its lowest level since December. We're going to have more of that next. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
As long as we're seeing the ongoing COVID-0 policy, we're not going to see much of a stabilization in domestic demand unless the government really moves away from its targeted approach.
At this point, it looks like that a rapid or a reckless opening of the economy will be worse for China's growth, because the biggest problem now, of course, is in the labor market.
For the time being, it seems that the outperformance that we have seen in the Greater China region could be capped in the very near term.
The next few months are clearly going to be challenging, but we still feel comfortable that in the second half, China is going to be a much better story from an investment perspective.
Interestingly, the mall is doing well, primarily because people can't travel. So we're seeing good spending and good foot traffic in the mall.
Some of our guests weighing in on the China protests, which have caused a risk-off mood in markets, especially oil. It tumbled to its lowest level since December, so it has made a round trip, this unrest in China. For more on this, let's get to Bloomberg's Will Kennedy, Senior Executive Editor for Energy and Commodities. Will, why has this rattled energy market so much, this oil market? Does this change the reopening narrative so much that we need to send WTI lower by 2.5%?
Clearly, it's a risk-off event for the oil market. Oil market has been extremely worried by the state of demand in China, that this adherence to COVID-0 is keeping demand suppressed, that people aren't moving around China as much, they're not driving, they're not flying. And that comes against a background of what seems to be ample supply. For all the talk of price cap and sanctions, Russian oil keeps meeting the market, keeps getting out of Russia. Russian oil production is near the highest since the war started. So you put that together, the supply from Russia with concerns about demand in China, and you get a slightly nervous, slightly weak market.
Well, to that point, OPEC Plus meeting is taking place this coming weekend. What do these declines, what does the China story mean for them?
Well, I think most people had expected the rollover. Obviously, OPEC Plus made a big cut at its last meeting, and it probably feels vindicated in that decision, given how soft the market has been since. But we should perhaps be looking at the possibility of a cut too. I don't think any decisions have been made yet. But if you think back until when the Saudis put out a statement last week denying speculation of a production increase, they clearly gave themselves room, and they said that they wouldn't be afraid to cut. So when you see a weak market like we've seen today, when you see prices nudging 80 on Brent, I think the market has to think that a cut is possibly part of the equation going into this weekend's meeting.
Now, well, you mentioned in your first answer oil price caps on Russian oil. Now, on Friday, we were supposed to get a decision by the EU, but it seems like no consensus has been reached, and they're going to restart these talks on Monday. Does it seem like this is something the EU is going to be able to be united on, or are there just too many divisions between the nations?
I think the expectation is that they will get to some form of agreement in the end. Clearly, what's going on is that those countries in Eastern Europe which want to come down hard on Russia want the cap set at a meaningful level, which will curb Russia's oil income. I think other members want the cap set at a price which would allow oil to keep flowing at today's prices. They're finding it hard to reach a consensus. I don't think they'll want to let the whole thing fall apart. It does seem that they'll get to a place which won't have a material impact on the flows of oil outside Russia. And I think that's what really matters to the market right now.
Okay, Will, thank you very much. Bloomberg's Will Kennedy there. Now, I want to switch gears to the ECB, where Klaus Knot, the ECB policy member, has been speaking in Paris, saying it is a, quote, bit of a joke to talk about over-tightening now. So we're looking at the euro on the highs for the morning. It is up 0.5% at its strongest versus the dollar since June 30th. Earlier this morning, he was also saying that the outlook for prices are still skewed to the upside despite the region facing a recession. Now, coming up, we're going to get back to the China story. Street protests in Shanghai and Beijing take place as Chinese citizens run out of patience with strict COVID curbs. We'll bring you updates throughout the show. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's now get to your first word news. With that is Alice Adkins. Alice.
Thanks, Danny. European Union diplomats are expected to resume talks later today on capping Russian oil prices. Poland and the Baltic states are unhappy at a proposal they consider too generous to Moscow. A senior diplomat says Poland wants additional sanctions as well as a review mechanism and a price below the market level. Taiwan's ruling Democratic Progressive Party has suffered its worst ever showing in local elections, with the opposition gaining power in the capital, Taipei. Taiwan's president quit as DPP party leader after the losses, which came amid rising disquiet over cost of living issues and an uptick in COVID deaths. Profits at industrial firms in China continue to decline in the first 10 months of the year, weighed down by COVID restrictions and falling factory gate prices. Industrial profits in the January to October period fell 3% from a year earlier. That's after producer prices contracted last month for the first time in almost 2 years. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Danny.
Laura, thank you very much. Laura Wright in London, not Alice. Laura, I love you. I promise I know what your name is. All right, let's get a check-in on these markets. And really, we started on the back foot with these risk markets, considering the concern over protests in China, what it means for policy, what it means for COVID lockdowns and China demand. European stocks continue to fall, being led lower by the energy sector, energy faring the worst out of any of those sector groups, given that we're seeing WTI crude fall nearly 3% at the moment. It has now made a round trip. We're looking at all of the gains in oil for this year being wiped out. Again, that China demand adding to it. We're talking to Will Kennedy about that earlier. You also have an OPEC Plus decision coming up this weekend. How does that factor in? Euro, that is moving higher, up 0.5%. That's being driven by some hawkish language we have coming from Klaus Knot, saying that the main concern is declaring victory on inflation too early, also calling it a bit of a joke to talk about over-tightening now, and that the risk to inflation forecast is entirely tilted to the upside. That is certainly some hawkish language. It also does mean that you're looking at a weaker dollar this morning. It started on the front foot. Really, the haven bid in the currency space has been to the end. If you look at the GMM screen, that is on the top of the Forex column there. That's the second column. Meanwhile, all those commodity currencies, they are being hurt by that lower oil, be it Canadian dollar or Aussie dollar, also a bid to U.S. Treasuries. Now, coming up, was Black Friday a success for the retail sector? We talk with eBay UK General Manager Murray Lamble next. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues.
We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
is really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Protests grip China. Demonstrations erupt in cities including Shanghai and Beijing in a rare show of defiance against the government's COVID curbs. European markets follow Chinese indices and U.S. futures into the red as the turmoil sends a shiver through global markets. Plus, commodities also hit. Iron ore and oil slide amid concern over the strength of the Chinese economy, with WTI dropping to the lowest level since last December. Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now let's talk retail. And eBay UK says the Black Friday shopping event no longer delivers on its promises as people struggle with the cost of living. And to help address the problem of post-consumer waste, the e-commerce company says it only promoted refurbished and second-hand deals this year. We're joined now by eBay's UK General Manager, Murray Lambell. Murray, thanks so much for joining this morning. So, how was Black Friday? Did the sales go off as expected? How did they compare to historical levels on eBay?
So what we saw in our UK business was just a booming sale in pre-loved, refurbished and used inventory. And that was because, one, customers were getting genuine bargains, and two, there was a definite shift in environmental concerns. We've seen that growing for the last few years, but it was more acute than ever this year. So that was our real high spot of the Black Friday sales, and will continue, I think, over this next few days as well.
Well, I know when you and the folks at eBay announced this push for reused goods, part of what you had said in this press release is that Black Friday is broken. Was this Black Friday also broken?
What's broken is that customers have got increasing concern of, am I getting a genuine deal or am I getting a genuine bargain? There's been tons of coverage of that over the last few years. And secondly, this growth in concern about the environment, it kind of went on pause during the COVID period, but has come back very strongly. And so over half of consumers that we spoke to were genuinely going after looking for used refurbished items this peak season for both of those concerns. Am I getting a real deal? And am I going to reduce the impact that I have on the environment? And so it's kind of playing out as I think it needs to. It's helping the retail industry shift to think about more about circularity rather than just production through to consumption and just that linear process. It's how do you think about products in a much more circular way? That plays to what consumers need, and there are so many great products out there when they're refurbished or used that customers can get. It's going to be a shift, I think, in the next few years in how the retail sector will operate.
Are you concerned, though, because typically in a crisis, in inflation, when consumer wallets are pinched, a lot of times sort of the ESG story gets thrown out the window. It means, folks looking for clothes go to fast fashion or go to the cheaper models that aren't necessarily environmentally friendly. Are you concerned that that shift will start to take place as inflation really starts to bite?
It's interesting. I've heard the argument a few times to say that you can't be environmentally friendly and have genuine value for consumers. And I find that a bit disappointing in that there's so much more out there. If businesses, our platform, our business is to help the retail sector showcase the brilliant in used and refurbished products. We've done things like classify our refurbished products when sellers sell so that buyers have confidence in what they're buying. We put guarantees around our products with things like authenticity guarantee, and therefore consumers can buy with confidence. And actually you are getting a genuinely lower price than you are on new items. And so actually this play of, yes, there's a cost of living crisis. Yes, I'm looking to save money, and I can have an environmental impact, can work in unison, and they don't need to be disconnected from one another, as is typically the argument. And we know that if you're buying a used or refurbished product, that the environmental impact is exponentially lower because you're increasing the length of time that product is in use.
What do you make of the UK consumer and the strength of the consumer right now?
I think that the UK consumer continues to surprise me. I think what we're seeing is a big push still in fairly high-end sales, so people buying more expensive items, so they're collector's items, whether they're buying sneakers or whether they're buying more high-end watches. And then I see a big play into I don't see necessarily this clear trading down, but looking for genuine alternatives to value. So rather than the latest iPhone release, get me the previous season or the previous season to that one, or get me an open box item because I know that that is going to be a genuine bargain for me. So a more thoughtful consumption than we've seen in the past, and that value for money just popping up on priority lists.
Is that the sort of K-shaped recovery, though, of on one hand you have people who are still willing to pay probably what is an absurd amount in my mind for a pair of sneakers versus, however cool they are, versus someone who's looking to kind of make sure they get that bargain?
I think that consumers are able to choose a diverse range of options depending on their need state, rather than customers being in Block A or Block B, as could be articulated. We've got one of the most advanced online retailing economies in the UK. It's an amazing part of our retailing sector. As I say, one of the most advanced in the world, and therefore customers are able to have a selection and say they want to spoil themselves here or treat themselves here, or they just want to get genuine value rather than feeling the need to always pay full price for all items.
So the demand is clearly there, but what about actually getting the products to consumers? How much of an issue has strikes from the Royal Mail, for example, been in being able to actually deliver?
To repeat the point about having the most advanced retailing economy, having a good postal infrastructure is essential to that. And that works in unison with the amazing online retail sector that we've got. And so our encouragement is clearly for the Union and for the Royal Mail to reach a conclusion as soon as possible, because it is detrimental to the overall health of our online retailing sector, that's for sure. I've also been encouraged by how private enterprise, other private enterprise has stepped into the fold and is helping to think about a growing capacity. Our job is to give alternatives for the businesses that use our platform and ensure that customers can get what they need and expect, and we'll manage expectations on both sides, but we do encourage the fastest resolution possible as it is disruptive.
If it doesn't get resolved, what does it mean for the holiday season then?
I think that customers are savvy and aware, and therefore they're more advanced in terms of their retail online shopping just because of the familiarity with it a few years on. Our job is to make sure that customers are fully aware of when to expect their item and then how it arrives, and I think most other retailers will be in that same position as well. And so I'm not expecting a big set of surprises, and as I said, pleasantly surprised by the way that other partners are stepping in to be able to mitigate those activities.
So what you're saying is I should have started my holiday shopping already.
Worth considering.
Okay, good to know. It is interesting, you know, speaking with friends of mine, all of a sudden all the options that exist out there to sell secondhand clothes and items, I won't buzz market them, but there does feel to be a lot. What has that competition meant for you?
Competition is a wonderful thing in terms of how it helps you up your game. We are the second largest retailing site in the UK. We have over 20 million customers that visit our site every month. They clearly find a great deal of value in their ability to sell and buy and transact on the platform. And when you combine that with the small business dynamic, we have hundreds of thousands of small businesses that use our platform to trade alongside consumers selling. It brings a richness of demand from customers who visit to buy. So all of those things work really nicely in terms of a network effect. And that's the beauty of the marketplace, and that's why the business continues to thrive here in the UK.
Do you expect consolidation in this space as these new players pop up?
I think that it's a very innovative space, and there's a ton of runway still to go. So still less than a third of sales in the UK for retail are online. There's a long way to go to evolve, and I'm expecting more advancement in terms of services and solutions. I've mentioned things like authenticity guarantee and our refurbished program, and those are really nice ways that we're helping to meet consumers' demands as they advance and get more specific in the types of products they're buying.
All right, Murray, thank you so much for joining us. Murray Lambell there, General Manager of eBay UK, after what was a busy Black Friday. Now, I want to bring you some lines coming from Barclays. Venkat, the CEO there, will undergo treatment for non-Hodgkin's lymphoma, according to the company statement, he said in the letter that the doctors have advised that my prognosis is excellent and my condition is curable with their prescribed regime. This is likely to last 12 to 16 weeks. The CEO also saying that the company will run normally, will still manage it. Again, this is the CEO of Venkat saying that the company will run normally and saying, I will continue to be actively engaged in managing it. Now let's turn to a different UK story, and Rishi Sunak is set to deliver his first major foreign policy speech as UK Prime Minister later today. He's expected to say the country should plan its foreign policy for the long term to match the strategies of other world powers such as Russia and China. Joining us now for more is Bloomberg's UK government reporter Emily Ashton. So Emily, set the scene for us. What are we expecting from Rishi's speech?
Well, it's interesting tonight because this is Rishi Sunak, the Prime Minister's first foreign policy speech. He's mainly known for his Treasury, a former Chancellor. So it'll be very interesting, lots of people watching. And he will talk about dealing with China and Russia with robust pragmatism. And that might be seen by some critics as maybe a softening approach to China. So a lot of eyes will be watching that. And as I say, this is a very interesting speech in the City of London because he is mainly known for his work with domestic affairs rather than foreign policy.
Well,
so lots of people.
I was going to say, speaking of domestic affairs, you know, Sunak perhaps the honeymoon period is over. What's the latest on this wind farm rebellion that he's facing?
That's right. So onshore wind is the latest problem that he has in his inbox. We have about 30 Conservatives who've said they're going to back an amendment from a senior Conservative to the Levelling Up bill, and they want to see more onshore wind built in Britain. Well, Rishi Sunak said when he was running for leadership that he did not want to see any more onshore wind. He has a real problem because Labour want to back that amendment, and so he faces the prospect of the government being defeated. So I think we might see, before that amendment comes into the Commons in the next couple of weeks, some softening of the approach, and maybe a concession from the government on onshore wind.
How much does this seem as an indicator for the rest of Rishi Sunak's premiership, given that, you know, when he took over as PM, there was some expectation that perhaps this is a more fractured Conservative Party. Will that continue to play out, and how will it continue to play out?
I think in a way we're seeing kind of politics as normal after a really strange few months. I mean, he came in as Mr. Sensible, trying to clear up the mess of kind of Liz Truss and Kwasi Kwarteng's government. And now he's seeing the reality of what Prime Minister means when you have a pretty fractious Conservative Party, different wings wanting different things, and a Conservative Party that is about 20 points behind in the polls. They want to do everything to get back up there and try and win the next election, and that is going to prove difficult for him.
Okay, Emily, thank you so much. That's our Bloomberg UK government reporter, Emily Ashton. Coming up, Mark Mobius calls $10,000 target for Bitcoin. It's at about 16,000 now as the unrest in China combines with the FTX scandal, creating more confusion in crypto. That's next. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about for those who says I love you and then betrayed you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get your Bloomberg Business Flash now. With that is Laura Wright. Hi, Laura.
Hi, Danny. China Evergrande Group says it expects to receive restructuring support from offshore creditors by late February. The statement came as Hong Kong's High Court accepted the company's plea to adjourn a winding-up case until March the 20th. Evergrande is the world's most indebted developer with more than $270 billion of liabilities. Elon Musk says Twitter is now hiring. The owner of the social media company tweeted a slide from a company talk with the words, "We're recruiting," but without any further details. This is a dramatic restructuring which has seen the firm's headcount slashed by half. Musk says new user signups have been at an all-time high. Turmoil at Apple's key manufacturing hub in China will be costly. Bloomberg has learned that the unrest is likely to result in a production shortfall of close to 6 million iPhone Pro units this year. The company that operates the facility, Foxconn, is trying to get workers back to assembly lines after violent protests against COVID restrictions. The government of the Bahamas has criticized the person in charge of restructuring crypto exchange FTX. Attorney General Ryan Pinder says statements made in U.S. bankruptcy proceedings by John J. Ray were, quote, regrettable and misrepresented actions taken by his nation's securities watchdog. The comments are the latest salvo in an escalating fight over the FTX collapse. That's the Bloomberg Business Flash. Danny.
Laura, thank you so much. Now let's talk more about that crypto story with cryptocurrencies following global markets lower, feeling that downward pressure of the protests in China. Now, at the same time, as Laura was mentioning, that FTX scandal continues. It weighs on sentiment of digital currencies. For more, Bloomberg's crypto reporter Anna Herrera joins us now. Anna, are you surprised that some of that angst over China is finding its way into this crypto market?
Not really. I guess before the FTX scandal, we were seeing crypto following other assets, and it was quite correlated, so it's not a surprise. But I guess we'll have to see what happens today, now that the U.S. is kind of reopening after the holiday last week. If there's more contagion from FTX, that might impact price more than what's going on in China.
So at the moment, maybe a return to normalcy of how it usually acts. Mark Mobius was also on the program a couple of hours ago saying that Bitcoin could go to $10,000. Are a lot of folks expecting that level of bearishness? I mean, how realistic is that price target?
He's not the first to mention it. And of course, if you look at what's going on in the crypto industry, that's not like a totally outlandish call. And again, obviously, we'll have to see if there's more contagion, then that might be a more realistic price target, right? If there's more company collapses, then, it's surprising that Bitcoin has held up so far so well. I mean, not compared to a year ago, but over the last few months, it stayed somewhat stable despite the catastrophes that were going on.
Yeah, fair enough. If we're expecting this gigantic ripple effect throughout the entirety of the industry, perhaps Bitcoin would be worse. Speaking of which, where do we stand on FTX, the proceedings themselves and those threats of wider contagion?
So the proceedings are going on in the U.S. We don't know who the creditors are yet. They've been able to keep those private, and they've the names aren't public, and that might be a source of potential, jitteriness, I guess that's the word, is going forward, because we'll figure out who might be one of the counterparties. And then obviously in the Bahamas, the regulators there have also been trying to act, and that's created a source of tension between the two, because FTX was based in the Bahamas, and the Bahamas have an interest in saying, you see, it's not our fault that the company collapsed. There were companies everywhere, and so they've tried to act as well.
All right. Anna, thank you so much for joining us this morning. Bloomberg's crypto reporter, Anna Herrera there. Now, for more on this ever-evolving digital landscape, listen into Bloomberg Crypto. It's a daily podcast hosted by Stacey Marie Ishmael. You're going to hear about the biggest stories from the most interesting people transforming the world of crypto. Find us Monday to Friday, wherever you get your podcasts. Coming up, European markets into the red following the drop in Asia equities. Those ripple effects from the protests in China not just being felt in Bitcoin, being felt across the world in risk assets. We'll wrap up the 2 first hours of the Open for you. This is Bloomberg.
more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets. This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, 2 hours into today's trading session, or just less than that, let's get a track of where we're at. It's Bloomberg's Joe Easton joining us on set now. Joe, it really does seem to be that the news out of China, the protest, potential reaction to it is just dominating risk sentiment, even in Europe.
Yeah, exactly. I think it's such a volatile situation to predict. I saw there was a report from Goldman saying that the Chinese economy could reopen in the second quarter of next year. I think that's probably about as reliable as one of my World Cup predictions. But I think that given we did see 2 weeks ago, we saw equity markets and oil move higher when there was news that China could reopen. Although this also came at the time when bond yields were moving lower, earnings were looking pretty strong. So I think there was a few drivers behind it. But now we're seeing some of that coming off today, and I think it's the main reason we're seeing markets lower this morning.
I do wonder if it continues to be the main driver because, you know, we are off the back of, 6 weeks of gains in European indices. Maybe it's not strange to see consolidation. But in terms of the calendar for the rest of this week, what looks like it could be driving sentiment?
Yeah, so we've got some big events coming up. Euro area inflation and inflation from specific countries, including Germany. That's going to be big. And also Powell's speech in Washington, D.C. That's coming ahead of the Fed blackout period, with the Fed's meeting coming up in just over 2 weeks now. So I think the main thing for markets is still inflation, and that will continue to be the main driver. But this China news is adding to that risk-off sentiment, so to speak. And I do think that going forward, maybe after today, I think people will be looking more at the inflation picture.
Yeah, well, I mean, to be fair, we are seeing the euro stronger today with Klaus Knot talking in Paris about this idea that, you know, it doesn't make sense that, you know, we would be talking about a pivot, that inflation is still enemy number one. Now, when it comes to inflation, I'm going to try to do an elegant segue here. House prices have obviously been a big driver, and the hope is that they're coming down with higher rates. We're also joking about in the break how I'm looking to sell, you're looking to buy, and so I'm expecting you to tell me that I'm the one who's in trouble at this moment.
Well, yeah, I think this story is probably a bit better for me than it is for you, because Zoopla today is saying that the agreed prices are falling below asking prices for the first time in 18 months. So it's becoming even more of a buyer's market, really, you know, getting better pricing. And I think that you had a guest on earlier from eBay, which was really interesting, and he was talking about how the UK consumer is actually a little bit stronger. Obviously, he's hoping that is the case, but I do think that we're seeing those signs of actually the UK consumer weakening and therefore trying to cut back and trying to reduce their spending, even on things like houses. And I think that, yeah, as we mentioned, good news for me, maybe not as good news for you.
Well, it's also probably not great news, I mean, for the Marks and Spencers of this world. Last time I checked, they were down pretty significantly. How much does 2023 turn into a bearish story for the UK retailers?
Yeah, I mean, it's got all the hallmarks of being a disastrous year for retailers, really. I mean, I think more mortgage payments could reach 50% of people's incomes, which is only slightly below where we were at the global financial crisis. Mortgage payments, utility payments, doesn't leave much money to buy new clothes to go out on the weekend, really. So I think that retail is looking bad, but then the stocks are down a lot. I think Marks and Spencer's is down 50% this year, or almost that amount. I'm not sure on the specifics, but a lot of it's priced in, but it's not going to be a good year for earnings, that's for sure.
Okay, Joe, thank you so much. And yeah, if you're looking to buy a flat, I've definitely got one to sell you. Mates rates, I promise.
I'll give you a buzz. Yeah,
Perfect. Bloomberg's Joe Easton there. All right, as we wrap up the hour, let's take a look at where we are on these markets. And as Joe mentioned, we do continue to see selling in this European equity market, following through on that negative Asia session, where Asian equities, specifically China, saw their biggest monthly decline saw their biggest decline rather in about a month. We're down nearly 1% with the Euro Stoxx 600. Energy, the worst of the decliners. You can see NYMEX crude now down more than 3%. It is the demand side of this equation that we are fearful of if there are more lockdowns, if it does get more stringent off the back of these protests and rising cases. Now, there is a bid into the 10-year yield. You can see there at 3.65%, or just nearly 6.6. You know, we are looking at a 10-year yield that is below the Fed target at this moment. It's this recession trade that's starting to come into the fold, and we are looking at a stronger euro with Kanata, as I was just talking to Joe about, very hawkish, saying that inflation, the risks are still one way, it is to the upside. Well, Bloomberg Surveillance Early Edition will continue in the next hour. Matt Miller and Kaylee Lyons are in New York, Anna Edwards out of London. This is Bloomberg.
Is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40 year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Be a
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Now, I think hoping for a change in attitude on the part of the central government is not in the cards. People are very, very frustrated, and they're willing to give up everything in order to get out of this situation.
As long as we're seeing the ongoing COVID zero policy, we're not going to see much of a stabilization in domestic demand.
The next few months are clearly going to be challenging, but we still feel comfortable that in the second half, China is going to be a much better story from an investment perspective.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Protests spread in China. Citizens frustrated by COVID restrictions take to the streets over the weekend to vent their anger about the government. The upheaval hits Apple. Turmoil at its big Chinese manufacturing hub may lead to a production shortfall of 6 million of the most popular iPhones. And the Chinese unrest adds to stresses in an already fragile oil market. Crude falls to its lowest level in almost a year. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, clearly the Asian equity session, Asian markets generally preoccupied by what we're seeing over in China and to some degree for global assets as well. And we're all focused on whether we see a return to that protest activity and how Chinese authorities will respond.
Yeah, and ultimately what it all means for the reopening of the second largest economy in the world, Anna. As you say, this definitely roiled Asian markets overnight. Broadly, it was a risk-off tone with stocks down really across the board. The MSCI Asia Pacific Index as a whole down by about 0.7%, but it was Chinese equities in particular that really underperformed. The Hang Seng China Enterprise Index down about 1.7%, and you're seeing the ripple into foreign exchange as well. The Chinese yuan, the onshore yuan, weakening against the U.S. dollar to the 719 level, but it is actually the South Korean won, which of course is very sensitive to the trade story with China that is underperforming in Asian FX, weaker against the dollar by 1.25% to around 13.40. And finally, in the bond market, you are seeing a bit of a haven bid coming into government bonds really across the world with yields moving lower. And that was true in both Australia and New Zealand. The New Zealand 10-year overnight falling about 9 basis points to 4.02%, Matt.
All right, well, we are looking at futures here that are down about 1% after doing a whole lot of nothing on Friday, really unchanged at about 4,026 in the cash trade, but we're down today on those China concerns. We're also seeing the 10-year yield come down as investors buy the bonds, so now down to 366 on the 10-year yield, which feels relatively low compared to the highs that we hit a couple of months ago. NYMEX crude is off 3.2%. You can see 73.83 a barrel. That's the lowest level that we've seen since early January of this year. So taking it down to levels that consumers may not be used to. The concern, of course, is that there won't be enough gas demand in China to hold the price up. Bitcoin also coming down, although still holding just above $16,187. So it hasn't crashed below that level, but we're going to hear from, for example, Mark Mobius later, who thinks it's headed towards $10,000 a coin. Anna, what do you see in Europe?
Yeah, Europe dominated by the China theme. Then, Matt, we've got European equity markets very much weaker today. Certainly that's the case for the French and the German markets, both of those down by just over 1%. The London market also down by 0.7%. Either it's an energy story, it's an industrial story, it's a luxury goods story. There are many areas in which, many industries which have links, of course, back to China from Europe. This is Brent crude then. Matt was just talking about WTI. Brent down by 3.4%. And even before we were talking about protest activity in China, it was going to be a complex story for oil to do with just how fast the Chinese economy was going to have to open up. We have an OPEC meeting coming up at the end of this week, OPEC Plus meeting. What will they decide to do on production? Has the chance of a cut in production just increased as a result of this drop we're seeing in oil prices right now? And this is how energy stocks are responding. We're down by just over 2% on energy stocks. That clearly weighing on the London market today. This weighs on Paris. LVMH is the example of a luxury player that I picked out, but I could have chosen others. Down by 1.3%. So the percentage not huge, but it is a really heavy GDP weight on the Paris index, and so that weighs on the Paris market. And the euro is up by 0.5%. And I put this in, Matt, just to underline, yes, we're risk off in many senses, but actually the dollar is under pressure today. Earlier on, it was actually gaining as a haven trade, but now we see the yen as a haven trade, perhaps even the euro. Our colleague Ven Ram talking about how the pound might be catching some haven bids because money coming out of some of the commodity-related currencies, such as the Aussie and anything to do with the Chinese market like the Kiwi. So that's what's going on in FX. Some slightly interesting moves going on here.
The euro as a haven trade. Very interesting.
It's a question.
Indeed. Yeah, big question mark after that one. Let's get back to the top story now out of China. Protests against COVID controls have spread across China, with some in Shanghai calling on Xi Jinping to step down. Veteran EM investor Mark Mobius spoke to us about the unrest.
It's clear to me that Xi cannot tolerate any protests. So there will be a very tough crackdown on any protesters. More people will be arrested, and they will probably go further in terms of control.
Enda Curran, Bloomberg's chief Asia economics correspondent, joins us now from Hong Kong. So, Enda, how significant are these protests really?
They are quite unprecedented, at least in modern times, for China. Matt, these protests are popping up in cities right around the country. Obviously, the scale differs, but it does speak to the level of frustration that is building among people on the ground now towards restrictions that go with COVID-0, and that's why there's a big question mark now over how the government will or will not respond. You've seen the images on social media. Our own colleagues have been vetting those images to report on them. They are quite extraordinary given the level of political control on political expression in China. So a lot of people have been taken aback by this, and they are asking a big question now in terms of not necessarily what it means for the government. They remain firmly in control, but what it does mean for COVID-0, and will there be some kind of a pivot, or how will the government respond?
Well, and on that government response, and is there any likelihood that there's a real threat to Xi Jinping at this point? Because we did hear some calls for him to be out of power.
Those are very unusual calls, obviously, not just for China, but as we have experienced here in Hong Kong, Danny. I think most experts are saying it's not at that stage yet. The protests aren't at that scale that it would threaten the government per se. But nonetheless, there is a lot of scrutiny now on how the government will respond. They will obviously continue to censor the media, the social media side of things. They've been allowing these protesters to vent to some extent, but will they now respond with maybe harsher police tactics, or will they crack down and arrest some of the ringleaders and the like? And going forward, do they then try and perhaps pivot to meet some of these COVID demands to try and ease the pressure on the people? Because China's trying to navigate a very difficult story here. On the one hand, they're saying, look, we have to keep the virus under control to avoid a public health disaster. On the other hand, they're saying people need to be allowed to live as normally as they can, minimize the restrictions. And that's the big dilemma that's led China to where it is today.
Yeah, and some of our reporting over the weekend really fascinating in the extent, the lengths that people are going to try and protest online in China, and to try and keep those protests up as long as possible to try and evade the AI. Thank you very much, Enda Curran, for joining us. Bloomberg's Enda Curran with the latest on those protests. Now, sticking with China, anti-lockdown clashes at Apple's largest factory could lead to a major deficit in the most in-demand phones. A Bloomberg exclusive report sets the shortfall at close to 6 million iPhone Pro units this year. Bloomberg's Tom McKenzie joins us now with some of the details. And Tom, we all remember the pictures. You know, before we were talking about protest activity more broadly. Last week, we were talking about protests at a Foxconn factory in China. And that's what this goes back to. How much of a challenge is all of this then for Apple?
Yeah, and it's a reminder that a company that is so good at managing its supply chain, so sophisticated, is challenged after 3 years of having to put up with COVID restrictions in some form in China. Of course, its most important production area and a major market is really being challenged. So what we're hearing is they're having to reduce output by about 6 million units. You talked about the iPhone Pro. It's the iPhone 14 Pro, absolutely, and the Max. So it's the most sophisticated, most in-demand smartphones for Apple that are being produced out of this facility in Foxconn, and so in Zhengzhou, and so they are being now constrained. There's a lot of uncertainty in terms of whether they'll be able to ramp that production up. We're hearing that they hope to be able to do that in 2023. Of course, the timing's terrible ahead of the Christmas and holiday season, and it's going to come down to what happens with those COVID restrictions. And yeah, as Anna was saying, Matt, you saw this outflow of workers in October. Then they tried to bring them back in with bonuses, and then there were those violent protests.
Yeah, big bonuses. And of course, Apple wants to diversify its production at the same time, right? So does this push them towards that in a faster way? What does it mean?
Well, the analysts that Bloomberg have been speaking to suggest that is the case. There's going to be a catalyst to move them in that direction. The reality is, and we've talked about this, that given how sophisticated and how entrenched those supply chains are in China, it is actually quite difficult to move because of the complexity and the sheer number of components that go into these phones to just lift it and move it to somewhere like Vietnam. But clearly, Apple have been attempting to do that, countries like India as well. And this, you would have thought, is going to play heavily on the minds of the board at Apple in terms of how they step that up in the months ahead.
Produced in China, designed in California. Certainly, the message coming across from some of the graphics we were showing there. Tom, thanks very much. Bloomberg's Tom McKenzie joining us with the latest on that particular dimension of the China story. It is having further impact on broader markets. The unrest in China has also affected oil, which tumbled to the lowest level since December. WTI sank below $74 a barrel following 3 weeks of losses. For more, we're joined now by Will Kennedy, Bloomberg's Senior Executive Editor for Energy and Commodities. Will, why is the oil market so rattled by the events that we've seen taking place in China over the weekend?
Because I think that it's clearly a risk-off event for many investors, that they're worried about what it means to the trajectory of COVID-0 in China and the outlook for the Chinese economy, which is the main driver of oil demand globally. And it comes at a time where the market already appears well supplied. Russia production and exports is continuing pretty much unfettered, albeit that oil is traveling almost all to Asia now. But production is near the highest since the start of the war. And there's more oil from a few other places in the world, like Kazakhstan. So it's all happening at a background of ample supply and uncertainty about demand, and that's turning out to be a fairly bearish brew.
Well, if we're talking about a bearish brew, what does that mean for OPEC Plus as they gear up to have their next meeting taking place this coming weekend?
Yes, I would say a few things about that. First, I think that OPEC Plus will feel fully vindicated in the production cut that it controversially made at its last meeting. If you remember, many places, including Washington, were very critical of that decision. But given the price we've seen since, with oil back down at its lowest in almost a year, I think Saudi Arabia, the OPEC leader, and its allies will think it was a correct decision. The decision they face now is whether to roll over production, which I think remains the base case scenario for most OPEC watchers, or whether they need to cut further. If you remember last week that the Saudis put out a statement saying that they would consider cutting. And I think that that's going to be the discussion over the next week. How weak does the market look? Does it require a further cut, or do they continue with their current policy?
Well, and Will, very timely, a headline just crossing the Bloomberg terminal, JP Morgan saying that OPEC Plus will need to cut 400,000 barrels per day next year to balance the market, cutting their 2023 Brent forecast by $8 to $90 a barrel. So Bloomberg's Will Kennedy, thank you so much for that timely reporting. Now, we also want to mention that it is Black Monday here in the U.S. Coming off of the start of the holiday shopping season, we saw modest growth for retailers over the Black Friday weekend. According to data compiled by Sensormatic Solutions, in-store traffic ticked up 2.9% at brick-and-mortar retailers over 2021. Deep discounts this year, lured shoppers seeking a break from inflation. Of course, those retailers trying their best to work down bloated inventories this holiday season. As for how all of these dynamics are translating into action in pre-market trading for some of those retailers, Amazon is down about 1% and Macy's down about 0.9%. So declines that are just a little bit beyond what we are seeing in the broader market. But of course, what is leading the declines in the broader market is the energy sector, what we were just discussing with Will Kennedy, with oil prices under pressure. So the likes of Marathon, Exxon, Devon, Occidental Petroleum, all down in the ballpark of around 2.5% to 3% in early hours this morning. And interestingly, two stocks that are sensitive to the China story are actually outperforming. That would be Wynn Resorts and Las Vegas Sands, casino operators that have heavy revenue exposure to Macau. The reason why these guys are up on a day when most Chinese exposed stocks are down is because of a license renewal for 10-year period that will benefit existing players like these two. So as a result, Wynn Resorts up about 6.6% and Las Vegas Sands higher by about 3.5% before the bell, Anna.
Coming up then, Kaylee, we'll get back to the China story. More on the unrest in China with Dr. Yu Ji, Chatham House Senior Research Fellow on China. How significant have the protests over the weekend been, and what kind of response can we anticipate from Chinese authorities? And on the markets, Joost van Lenders joins us. Van Lanschot-Kempen, Senior Investment Strategist. How is he rethinking China risks and the reopening timescale around China as we see what has been developing over the weekend? Plus, we won't forget about crypto, the latest on the FTX saga with Daniel Seifert, Coinbase Vice President and Managing Director for EMEA. They're actually expanding at the moment. Any second thoughts on that post-FTX? We will talk to Daniel shortly. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London. We want to focus in now on China as protests against COVID restrictions are spreading. Citizens took to the streets and university campuses venting their frustrations on local officials and the Communist Party. Huge crowds gathered in Shanghai where some, or at least one, let's say, called on President Xi Jinping to step down. That's a level of dissent unheard of since Xi took power a decade ago. Dr. Ji Yu, Senior Research Fellow on China in the Asia Pacific program at Chatham House, joins us now. Dr. Yu, thanks so much for your time. How do you see these protests in terms of, how substantial they are? Are they really unprecedented?
Well, obviously, it's quite significant as China have not seen that sense of joint forces across different parts of the country and different social classes and somehow go against this zero COVID strategy on the one hand. But I think on the other hand, considering the number are extremely small, and also they are basically asking the government to withdraw zero COVID policy, but it's not exactly anti-party and anti-government as such. So I think let's distinguish this. This is not really the so-called 1989 moment again. I don't think so. Even though I do know that people would prefer to making historical preference and relevance for this, but unfortunately, it is not.
Okay, so you don't see parallels with 1989. Does it have an impact on policy, though, Dr. Yu? I mean, I spoke to a guest from Citi earlier on who said there'd be no change in COVID policy as a result of these protests because that would result in a loss of face for the government. Is that a line of argument that you share?
No, I don't. I think the changes has already happened back to 11th of November. And obviously, there's a differences in terms of implementation from the central government to local government. But local government double down the measures. So that's one thing make the central government very frustrated. Then on the other hand, I think also we're going to gradually to see the change in rhetoric and change in languages in terms of the policy from the central government, from Beijing. So I think, yes, the way forward, it is to loosening the measures, but the matter is how and when the government will find the right step to losing that measures.
And will it be possible, Doctor, to loosen the COVID policies at a rate that the Chinese population finds acceptable, and define that however you like, but with infection rates set to go even higher than they are now and deaths no doubt to follow, how will that be explained to the Chinese population that have been told that the Chinese way of managing this is far superior to Western methods?
I think that's the difficulties, whereas the public wasn't really have the sufficient awareness regarding what kind of virus Omicron it is. So I think that's probably one of the biggest hindrance that prevent the Chinese government to reopen the society. So for what governments have to do right now, it is to have a very clear communication with the population, firstly, and what percentage of vaccination coverage that society can open, firstly, and secondly, and what percentage of SU bed availability that society can be open. Until these two messages come across very clear to the population, I think we're still in a very confusing stage.
Well, and I wonder as well how the difficulties around exiting COVID-0 translate into other questionable issues in Chinese policy. One of our Bloomberg opinion columnists, Clara Ferreira-Marquez, wrote in a column out today that Beijing's ability to reset public health policies is also a crucial indication of how an increasingly tightly controlled and centralized system will unpick other tangles, be they social, economic, environmental, or geopolitical, that require the same kind of pragmatism. How do you see this translating into other areas of policy, Dr. Yu?
Well, the difficulties in here, it is how to balance the public health and economics like any other country facing in the exit procedure. So for China's case, is how are you going to guarantee those who will not be employed by the state sector a proper insufficient amount of money available to be dispensed in household. And so far, we have not seen that guarantee from the Chinese government at the central level. So I think that is the difficulties, whereas how are you going to balance the economic interest of the billions, then on the other hand, the public health issue.
And of course, it's kind of domestic versus the rest of the world. I mean, how is the persistence of COVID-0 policy and kind of the hindering of the Chinese economy affecting potentially this country's standing in the international balance?
Well, it looks very... China looks like the very odd one in this sense. You know, the rest of the world began to reopen or has already opened for quite some time, whereas China is the only one seems to alone to persist on this zero COVID strategy. So that really leaves China and also leave the Chinese population wonder what exactly happened within their own country. So it's no wonder people will have a question. It is no wonder people are angry.
Do they have, I mean, does China even have the ability to lift zero COVID without millions of deaths? Do they have decent vaccine preparations? Do they have emergency room beds free? Do they have enough ventilators? Are they prepared for lifting COVID-0?
Well, I'm not a public health expert in here, but I mean, as far as I know, in terms of vaccination to prevent death and serious illnesses, I think the Chinese vaccine is the same as any type of vaccine. As we know that any vaccines, including Pfizer, cannot prevent you from getting infected. So I think what the Chinese government is trying to do right now is try to nudge the elderly population get vaccinated. And so far, I think the government has not really been quite successful. Now, in terms of the SU bed occupancy, I have to say the SU bed availability within China is relatively low compared with the rest of the world, and especially compared with peer-to-peer comparison for many of the emerging market and middle-income country. So I think that's another hindrance for the Chinese society to be fully reopened.
And back to the focus on the protest activity that we see preoccupying news right now, Dr. Yu. If we do see a return to protest activity tonight, for example, or in the days ahead, would you expect it to be met with a violent response?
I don't want to make any predictions in here, as we don't know exactly what has happened. I mean, I'm not within the country. But I think on the other hand, if people do have the anger, the best the government should do is really to letting people vent those anger.
All right, Dr. Yu Zhe of Chatham House, thank you so much for joining us. Really appreciate your time and insight today. Now let's keep you up to date with news from around the world outside of China with the first word. Republicans say they'll demand greater oversight of U.S. military aid to Ukraine when they take over the House. Representative Michael McCaul told ABC News there will be more transparency and accountability. McCaul also said he supports sending Ukraine long-range weapons to defend against Russia. The CEO of Barclays will be undergoing treatment for non-Hodgkin lymphoma. CS Venkatakrishnan says that doctors have told him his condition is curable, and he expects treatment to last 12 to 16 weeks. Venkat plans to continue running the bank during that time. In the UK, Prime Minister Rishi Sunak is facing pushback from his own Conservative Party over a ban on new onshore wind farms. More than 20 Conservatives are backing a pro-wind energy amendment. Soaring energy bills have prompted a number of them, including Prime Minister Boris Johnson, to drop their opposition to wind farms. And after cutting thousands of jobs, Twitter is now hiring. That's according to slides from a company talk tweeted by owner Elon Musk. The first slide has the words, "We're recruiting," with no further details. The slides also said that new user signups are at an all-time high, averaging over 2 million a day in the second week of November. So yet another turn and twist, Matt, in this Twitter saga as Elon Musk has taken the helm. First, he lays off half the company. Then he makes demands of workers that lead some of them to take essentially just packages to exit the company. And now he wants to bring more people back in.
Yeah, and apparently they're signing people up at a record rate. I don't know really what to believe here. I would have thought a lot of people had quit Twitter as well, but I'm not sure about the data there. And of course, since it's not a public company, it doesn't really matter that much, but we love talking about it, Anna.
We love to, well, journalists certainly love talking about it, and the longer you spend on Twitter, the more you think maybe it is just journalists talking to each other, but I'm sure many other people enjoy discovering new contacts via that particular social platform. Just a shame you can't, if you want to leave, shame you can't very easily package up your contacts and take them elsewhere. I know others have been writing about that over the weekend. Coming up on the program, we'll get back to the market moves that we're seeing, reflecting and bouncing off what's going on in China. Joost van Leenders joins us, Van Lanschot-Kempen, Senior Investment Strategist. What are the risks surrounding China and the reopening assumptions we might have made about the Chinese economy that Joost is factoring into his investment outlook? We'll get to that. And the read across into other assets, be they FX or commodities. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could we've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close.
Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Protests spread in China. Citizens frustrated by COVID restrictions take to the streets over the weekend to vent their anger about the government. The upheaval hits Apple. Turmoil at its big Chinese manufacturing hub may lead to a production shortfall of 6 million of the most popular iPhones. And the Chinese unrest adds to stresses in an already fragile oil market. Crude falls to its lowest level in almost a year. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, we see this story go around the world then, weighing on European equity markets, now weighing on US futures as well.
Yeah, absolutely. Futures down almost 1% right now. Actually, a little bit less than they were about a half hour ago, but still off. Right now, we're looking at 4,001 on S&P futures. The cash trade on Friday closed at 4,026. Just so you can mark your place here. We're also looking at 10-year yields that are coming down. Right now, almost 2 basis points, but it's a pretty substantial drop from what we've seen. Just a month ago, we were up over 420, and now we're at 366 on the 10-year yield. So a lot less competition there is one way you could see it with S&P yields. On the other hand, that is because people are buying treasuries and maybe a little bit worried. They're not buying the U.S. dollar index, which I think is very interesting right now. Crude off about 2 2/3% right now. 74.24 is the price for West Texas Intermediate. So that has come down to levels that we haven't seen really since January of this year. And then Bitcoin right now off 2%, but still at $16,209, still holding above 16,000. Even though there's continued FTX fallout, it doesn't seem like it's enough to drive the price of Bitcoin down. Kaylee, what do you see in terms of pre-market movers?
Well, a lot of them come back to that China story. It's affecting things on the macro level and on the micro as well, with the ADRs, for example, of some big Chinese technology companies down in pre-market trading. Baidu by about 0.9%, JD.com by about 1.5%. You also have Apple lower. Anna mentioned this story. They could face a production shortfall of iPhone 14 Pros by as much as 6 million units due to the disruptions at facilities in China. So Apple is down about 1.8%. And then with the declines in oil Matt was mentioning, you are seeing energy stocks under pressure. The Energy Select Sector Spider ETF, which basically gauges how the sector as a whole will be performing come the opening bell, is down on the day by about 2 percentage points, Anna.
So those are some of the moves that we're seeing in pre-market trading then around the China story, Kaylee, on US assets. Well, this is the European verdict on the China story. The European equity market space down by 0.8%, and all sectors are in negative territory here in Europe. Real estate and energy are the worst performers, and here's Brent crude, 81.30, down by 2.8%. Even before we got the protest activity, there was a lot of complexity being built in as we saw COVID rates rise in China. A lot of people asking questions about just how quickly can China realistically reopen. And as a result of that, there have been some downward pressure on oil markets. Add into that, we've got an OPEC Plus meeting at the end of this week. Will we see a cut in production to respond to this weakness? LVMH is down by 0.7% on the Paris market. And this, again, is to do with the China story. So we see this read across from China into some of the luxury goods companies that are listed in Paris. Not a great percentage point move, perhaps, but it is a real heavyweight on the Paris market, and so it takes its toll. The euro is actually up by 0.7%. And this is an interesting one. Perhaps we'll get our guests' perspective on this shortly, Kaylee. Up by 0.7%. Through some of the Asian session, we saw the dollar catching a bid. That seems to have changed. Now we've got the yen moving higher, and we have the euro moving substantially higher. I spoke to our colleague Ven Ram on the Markets Live blog earlier, and he was saying that maybe this is to do with interest rate differentials and the slightly more hawkish language we still see from the ECB in the context of the more dovish minutes last week from the Fed. But could all that change when we hear from Jerome Powell a little bit later on this week?
Yeah, Anna, we all definitely will be watching Powell's comments on Wednesday. This morning, though, what we are all watching is the China story and the ripple effects throughout global markets. Joining us now to discuss is Joost van Lanschot Kempen, Senior Investment Strategist. Joost, how exactly are you looking at the China story and the uncertainty around it?
Well, I think there are two things. You see uncertainty in supply coming back with the restrictions Apple has mentioned. So maybe that restrictions can be so severe that that manufacturing supply will become under strain again. That would add to inflationary pressures in the world. But I think the main impact is on Chinese growth. And we hadn't factored in too much optimism on the lockdowns in our forecast. So we've seen some measures, some easing measures, which have some have also already been reversed. But we didn't think that a real significant reopening would be feasible before spring, basically. And there had been some optimism, and now it's sort of reversed. We see the number of infections increasing, and the policy, the zero COVID policy hasn't really changed. So yeah, that's the demand side for China itself, and then also the ripple effects through the global economy, which have the negative impact now. So
Joost, what are those knock-on effects? What are those knock-on effects that you're seeing in terms of global markets where you are?
Well, energy, definitely. So commodities in general, I think. And so that's basically the demand from China. Yeah, the luxury goods that were mentioned, maybe some car manufacturings that can be impacted. So yeah, it's a mixture of supply and demand, I would say.
In terms of safe havens, we haven't seen investors rushing towards the dollar. Indeed, the euro is bid this morning. Is that peak behind us? Do you think the dollar strength has now turned around and we're looking at continued weakness for the dollar?
Yeah, that could be. I think we're close to the peak also with the Fed. The ECB is more tricky in terms of inflation, and the comments that we've seen. They're more, they're a bit more on the hawkish side currently than the Fed is. So I'm not sure if we're in the peak because the Eurozone economy is weakening. So I'm not sure that the Fed will really get to where the markets expect it to be, right? The Fed is expected to hike rates to 3%. If the economy really slows as we expect, then we might see a bit of a lower peak. So I'm not sure if we've really seen that we will see weakness in the dollar, but a further increase, is getting more difficult to because the Fed is also getting to the peak of interest rates.
So, Joost, does the buying of the euro today, does that look a bit overdone then, given what you just said? I mean, we're up by 0.7%, and my colleague suggesting maybe this is, another 75 basis points coming from the ECB soon, whereas the Fed is about to step down. Is that really what's in the driving seat as we try and work through what is impacting FX markets right now?
Yes, yeah, that could be. So it's very much so that is very much the short-term expectations. I think within the ECB, it's not a done deal that we get a 75 basis points hike. 50 basis points is also possible. That would also mean that the ECB is slowing a little bit. So this is very much, I think, the moves that we see today is very much about the December meeting. But when you look beyond that meeting, I think it's getting more difficult for the ECB to keep rising rates, especially at a fast pace, than for the Fed, because the Eurozone economy looks weaker to us. We do think that the US will slow down. We see that in leading indicators, but not so much in the real indicators yet.
Okay, and so on that subject of the European economy, Joost, and how quickly it slows down and how you invest around it, I see that you've reduced your underweight in Eurozone government bonds. Is that because you think that will be a good place to spend the recession?
Yes, yeah. So we've moved more into bonds. I think a couple of months ago we reduced our exposure to US equity and bought US bonds, and now indeed we still have an underweight in European bonds, which we reduced that underweight because we think yeah, maybe we're already past the peak. I mean, German yields have also, 10-year yields have also fallen to 2.4 to 2.0, so it's also 40 basis points decline. We also reduced our duration exposure, so that's more in line with that we're getting closer to a peak in European yields, yes.
And when it comes to equities, you mentioned kind of pulling back on your exposure to U.S. equities as well. When will it be time to wade back in more meaningfully?
I think when we have clearance about the recession and how deep it's going to be, I think we also need at least a peak in the Fed. And there's been much talk about the pivot. I think the definition has changed a little bit. We see a pivot really as a start of rate cuts, and that's I think too far away for equities to anticipate. And I think also that earnings expectations have to come down. Earnings expectations are positive for the year 23 in the US and in Europe, and I don't think that matches a recession.
Joost, you say that the Fed beginning to cut is too far away for equity investors to anticipate. Does that mean not in 2023? You don't see that?
It may be 2023, but we think it would be quite late in 2023. And then first you'll have the economy slowing. Yes, you'll have inflation coming down, but you also have, I think, earnings coming down. And I think that will be a bigger story for the time being for equities than, I mean, we've seen sort of the enthusiasm about the pivot. Equities up being sort of up 12-30% from the low in, what was it, October. So that's there, but now we think that you will have the earnings story, which will be more negative.
Joost, thanks so much for joining us. Good to speak to you. Joost van Leenders of Van Lanschot Kempen. Thanks for bringing us your investment thesis right now. Coming up on the program, we'll get back to the crypto story. Daniel Seifert, Coinbase Vice President and Managing Director for EMEA, comes to talk to us about European expansion. This at a time, of course, when the sector is still reeling from the FTX fallout. More on that shortly. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Now, the crypto rout has room to run, according to veteran fund manager Mark Mobius In an interview with Bloomberg, Mobius said his next target for Bitcoin is $10,000, and he added that he wouldn't invest his own cash. But, quote, crypto is here to stay, as there are several investors who still have faith in it. It's amazing how Bitcoin prices have held up, which I think we can all agree with. Joining us now, Daniel Seifert, Coinbase Vice President and Managing Director for EMEA. Daniel, what do you think about the underlying asset, I mean the OG asset, right? Bitcoin still at over $16,000, even with all of this FTX negativity. Does it make sense to you?
Thank you, Matt. It's incredible to see the events on the market that we've seen in the past 2 or 3 weeks. Certainly, this has been a major setback for the industry as a whole, the FTX debacle. That said, Coinbase has always sought to be the most responsible, trusted, and secure exchange. And we keep customer funds one-to-one segregated. And therefore, there can't be a situation like with FTX, with Coinbase.
What kind of situation have you seen in terms of outflows? I mean, I know a lot of customers are saying, I trust Coinbase that they're holding our assets one-to-one. On the other hand, I would prefer to take my digital assets out and hold them in my own wallet. Are you seeing that?
So we're a publicly US listed company, so I have to be, of course, mindful of what I'm saying here, but we see elevated activity, and when we speak to institutional investors, they are very positive. Both live and onboarding institutional investors are they have all expressed their faith and trust in Coinbase, and they're probably letting the fallout settle, but they're certainly here to stay for the long term.
Do you eventually see yourself coming out of this whole episode with greater market share, Daniel?
So Coinbase, I think we have taken this approach of seeking to be the most responsible, trusted, and secure platform ever since our founding in 2012. That was at the time a down market. And we've ever since navigated through 4 entire crypto cycles. I think we sort of see ourselves validated in our approach to be the most compliant and most responsible crypto exchange globally.
Well, on the subject of compliance with regulations that still exist, what regulatory clarity do you still need, given you are, as you say, based in the US?
Absolutely. There's certainly more regulatory clarity in the US would be appreciated. As you mentioned earlier this morning, we have made additional appointments of senior leaders in the EMEA region, as we see the EMEA.
It looks as if we've just lost the line to Daniel Seifert, whose time we appreciate greatly because he was coming to us from San Francisco, so perhaps we'll get a chance to re-establish that line. But Matt, interesting to hear him talk there about what this does to the business, or where they see the business being resilient to all of the FTX fallout.
Yeah, and also fascinating that they're pushing to expand into regions that you know, maybe also less regulated or not have kind of regulatory completion amidst this fallout, right? You'd think that you want to wait and see what happens.
Well, I think they're talking about expansion in Europe, aren't they? And saying that actually the regulatory approach is one of the things that draws them to Europe. So that's sort of another dynamic, the complex relationship between where you want to expand and how the regulatory environment really differs. And Kaylee, it was interesting over the weekend to see the Bahamas, to see Dubai, places that had really put themselves at the forefront of crypto, questioning whether that was really the right call.
Well, and you saw Bahamian regulators kind of pushing back on some of the claims made in the bankruptcy proceedings around the implosion of FTX. We know that is one of the things that has created a very significant gray area, is the jurisdiction between the Bahamas and in the US as well, given that FTX was an entity based in the Bahamas. So there is a lot of confusion, but coming back to Coinbase, the fact that it is based in the US, Matt, maybe feeds back into the idea of it being subjected more to the regulatory oversight of authorities here in the US, Anna, but clearly something that players all across the market are still paying a great deal of attention to.
And I think Daniel Seifert is once again with us, so let's get back to him. You were just telling us, Daniel, about your European expansion and the timing of that. Apologies for the line going dead there. You were talking about European expansion. How do you justify that kind of confidence, I suppose, in the industry at a time when many are questioning where it goes from here post-FTX?
Yeah, thank you, Anna. As I said previously, certainly when we talk to institutions, we see the same confidence and the full confidence in Coinbase that we've seen previously, and we do not see anybody leaving the space. And that said, given that EMEA, and when I mean EMEA, I not only mean the European Union with the MiCA regulation, but also the Financial Services and Markets Bill that's passing through the UK Parliament at the moment, as well as the creation of the VARA, the Virtual Asset Regulatory Authority in Dubai, is really leading the charge in creating regulatory clarity and a regulatory framework that we can work within.
Do you think, though, that perhaps tougher regulation might follow, Daniel, in the UK, in Europe, as a result of FTX? Because a lot of people were perhaps disappointed by the lack of transparency in the sector and might be asking questions about what needs to be done about that.
I think you're right. It depends a little bit country by country and market by market. Me being German, you will know about the Kryptoverwahrgesetz that was introduced in 2020 in Germany. So we have already a very comprehensive framework for regulation of crypto assets in Germany. Other markets, we expect them to follow similar approaches.
How far behind is the U.S., Daniel, when we talk about these other countries Anna was alluding to that maybe are a bit more forward in terms of thinking about setting the regulatory landscape for cryptocurrencies?
So what I can comment on is obviously the EMEA region. The United States is certainly looking at creating greater regulatory clarity. In the EMEA region, I can say that I think we have made great headways, and we're looking forward to the introduction of that MiCA regulation soon.
Daniel, thanks so much for your time. Sorry about the technical difficulties. Daniel Seifert there joining us from Coinbase to talk about the expansion the company has planned, plus the fallout, obviously, from the FTX saga. Tune in to Bloomberg Crypto. That's every Tuesday at 1 p.m. New York time, at 6 p.m. in London. For more of our coverage, our weekly show covers the people, transactions, and technology shaping the world of decentralized finance. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line of success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week I try to create serendipity.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now let's take a look at what is ahead this week. It's Cyber Monday today with retailers offering deals online after Thanksgiving. I know I myself have done a lot of online shopping over the last several days. Then tomorrow, Tuesday, Twitter is set to relaunch the Blue Check service. A lot of drama around that. You can pay instead of just getting outright verified. Then Wednesday kicks off the NATO foreign ministers meeting in Romania. Plus in Washington, Fed Chair Jerome Powell will be addressing the Brookings Institution. Then on Thursday, President Biden will be hosting French President Emmanuel Macron at the White House. And then on Friday, it is Jobs Day here in the U.S. That non-farm payrolls data is expected to show some softening in the labor market. And wage data, of course, also going to be very closely watched, Matt.
Yeah, it's interesting. There's a lot of important economic data and Fed news coming up this week. So while I know over the weekend we have all been reading about these Chinese protests, and of course today that's the focus of the markets, it could look a little bit like a tempest in a teapot come Wednesday when Jerome Powell speaks, right? Because we're going to all shift focus completely, Anna, back to what the Fed does and how the U.S. economy responds.
Yeah, absolutely. So Jerome Powell speaking on Wednesday, and last week a lot of the market talk was dominated by the relative, I emphasize relative, dovishness of the Fed minutes that we saw, Kaylee, and then questions coming back about how Jerome Powell is maybe a little more hawkish than some of the other members of the FOMC, and that might be something, a contrast that we're once again talking about today when we get to the middle of the week. Also interesting to see that Powell will be speaking about labor markets, and we will get a lot of labor market data this week.
Yeah, it'll be interesting to see if you are seeing the kind of softening that the Fed is trying to engineer. They would like to see some slack building in the labor market and demand for labor going down as they try to cool the inflationary pressure. So it'll be interesting to see how much progress we are getting on that front as we also beat the drum to the Fed's meeting in just a couple of weeks, Anna.
Yeah, also beating the drum through the World Cup games, of course, continuing in Qatar. And let's hope the action on the field gets a little bit more exciting than it was on Friday. I don't know if either of you watched the USA-Indian game, but it was a fairly boring affair. Apparently very well watched in the United States, for which I apologize. Right, let's get to the end of the program then. This is it for Early Edition. Surveillance is ahead. They'll be speaking to Morgan Stanley about where assets go from here and about China. This is Bloomberg.
Successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that It keeps evolving. You know, we started out just as started out a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
The global economy is clearly slowing, and that's the backdrop.
It's the global labor market that's really holding up still.
The key surprise of this year, right, has been the resilience of the labor market.
We have had a very steady pace in terms of overall spending, and the labor market is great.
There's definitely a chance of a replay of headline inflation volatility next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK taking a long weekend. He'll be back in a couple of days' time. Equity futures down 0.8% on the S&P 500. Bramo, it's the final stretch of 2022.
And it's getting gloomier, and yet it's really interesting that we're not necessarily seeing the gloom translate into higher yields because of inflation going forward. It is a lower yield, lower stocks kind of morning. The idea that perhaps this is risk on, and what's bad news is really bad news.
Should we go through the calendar? December 2nd, payrolls, this Friday. Then December 13th, CPI in America, the day after the Federal Reserve. I think we hear from Chairman Powell on Wednesday. And looking out to 2023, we want to know, I guess, two things. One, show me what the Fed's going to do. And two, tell me what China's going to do. And the China question gets a little bit more complicated after the events of the weekend.
I was going to say China looming really front and center with all these outlooks, how much get ripped up right now based on what happens in China right now. The protests really questioning how long zero COVID can last, given the fact that Xi Jinping is trying to tamp down protests in a way that some people say they have not seen potentially since Tiananmen Square.
You're looking at the same thing I'm looking at in the market off the back of this. Equity's down, and I get it, we get it. You sell risk and you ask questions later. Crude in the 70s, in the low 70s off the back of all of this. Your thoughts on what's happening with the price action off the back of the story of the weekend?
I reject it.
You reject it?
Why
do you reject it?
I just don't understand why what's going on in China means lower crude, because ostensibly more protests and the speculation of a faster end to zero COVID, because how does Xi Jinping deal with this? This is social unrest and economic pain at a time where they have to move away from zero COVID at some point. If they move away from this sooner, doesn't that mean that crude goes up? Doesn't that mean that the bid goes up? Doesn't that mean that globally the inflation?
If they move away from this sooner, if they do.
But if they don't, how do they sustain this? Do they just tamp down? Do they put iron doors on all of the apartment buildings? How do they tamp down on this unless these protests aren't real? But from all of the imagery, it seems like it's spreading in a significant way.
The range on crude we've seen over the last month, in the month of November alone, we've had a $20 range on WTI crude from the low 90s to the low 70s. The broader price action looks like this morning. Good morning to you all. Equity futures on the S&P 500, negative and down 0.8%. Yields doing their thing on a 10-year. We look like this on a 10-year right now, basically unchanged, 367.93. Talking about the range of November, the range of the year on euro dollar, back to 104.85 on euro dollar, positive 0.9%. So a stronger euro in the mix. I'll talk about the ECB speak a little bit later. Bramo's going to run you through that and the Fed speak in just a moment. Crude 73.93. There's the move, Bramo, a move of more than 3% lower on the session.
And somebody else who's probably a lot smarter than I can explain it other than just rejecting it outright. And we look forward to them coming on and doing that. Today, what we're looking at when you talk about ECB speak, Christine Lagarde is addressing the European Parliament at 9 a.m. I'm very curious to hear how determined she is to raise rates and keep rates higher in the face of the highest inflation since the Eurozone was created, above 10%. If you take a look at the latest reads, European ECB Governing Council member Klaus Knot said earlier today that the idea of us being over-tightening or over-restrictive at this point is a bit of a joke. So just to give you a sense of where others are. Today, New York Fed President John Williams speaking at the Economic Club of New York. How much does he really push back against some of the recent lift that we've seen in stocks? We're not seeing it today. But just the Financial Conditions Index, which I know Tom looks at a lot, it's weaker than it was at some of the weaker points back in October and even earlier in 2018 and 2017. So how much do we end up with this? And today is Cyber Monday. Are you buying stuff?
What difference does it make? Cyber Monday, Black Friday, doesn't it all happen at the same time anyway?
That's the point.
What's special about today?
That's the point. And so are people doing less of it because they're preloading and backloading and everything loading because it isn't really that different from any other day? Are people not buying it? We've seen Amazon shares down more than 40% year to date. And today, on this big day of shopping, they're still down. So I'm just giving you the sense. I agree with you.
We on the same page? Good. Apple's down about 1.9% in the pre-market.
Yeah.
Our story this morning, the lead paragraph on Apple, turmoil at Apple's key manufacturing hub, likely to result in a production shortfall of close to 6 million iPhone Pro units this year. Lisa, that's according to our reporting this morning.
And Apple has been the one tech company that's been immune to a lot of the pressures felt at some of the other companies. They haven't seen the same kinds of layoffs. They haven't seen the same kinds of margin compression. They still have a ton of cash. Will this change that narrative?
We'll pick up on that story a little bit later with Dan Ives of Wedbush later on in the program. Joining us now is Brian Weinstein, the head of fixed income at Morgan Stanley Investment Management. Brian, I want to start with the events, the unrest in China over the weekend, and walk me through how you and the team are thinking about it this Monday morning.
We think it's just part of the broader story of more economic turmoil, uncertainty, and slowdown. And Lisa, we hear you that it's certainly possible that the zero COVID ends early, and that would be a game changer. But it's just as possible that the clampdown comes, uncertainty stays, supply line problems rebuild, and it just causes more economic slowdown out there. So it's a tough one to figure out on a minute-by-minute basis. But for now, the zero COVID seems to be here, and it seems to be part of. You look at yields, right? The yields are falling. Economic growth is slowing around the world.
But Brian, on the flip side, either way, whether they keep COVID zero and it causes supply chain kinks to last for longer, or they release it and it causes demand to go up, either way is inflationary, no?
It does seem so. Again, if you look at if you look at where we price inflation to go to back to the twos, it's very optimistic, right? There's many reasons to believe inflation will stay stickier, makes the Fed's job harder, makes the curve stay unbelievably flat and maybe get flatter. Yes, we would agree with that. It's hard to see inflation pressures easing off completely, though I do think the direction of travel the next 3 to 6 months will be lower.
But to that point, Brian, the move in 10-year yields has been notable. Long-term yields have been bid dramatically over the past couple of weeks. This has been the one consensus trade, and perhaps people getting ahead of the first half of next year and doing it all now. Has it gotten over its skis considering how long inflation could remain higher, how determined central banks around the world are to be restrictive for a sustained period of time?
Maybe. I've been impressed with how far we've come. And we went from a period when 10-year notes were 450, where it felt like nobody would ever want duration again. And here we are at 370, and we feel okay. I think this is the stage where if we got a little bit of weak economic data, you could have another leg to this rally, call it 325 on 10-year notes, get the curve really inverted, minus 100, maybe a little bit more. Long term, do I think we're having a big fixed income rally? No, I think the income is great. You don't want to chase too much, but I do think you could have another leg here, given that data could get weaker.
If you think we could get another leg lower in yields, does that mean you think maybe risk has overdone it here, Brian?
I think so. I think that's the trade here. I think all year we had duration leading risk assets lower. This rally, duration did better, but risk assets did well too. If we rally again, I think it's because risk comes off. We accept the fact that next year is not going to be easy, that earnings could be worse than we think, that uncertainty is high, and that duration actually is still cheap relative to risk given what happened this year.
I'm looking right now at high-yield bond spreads, just to build on what John was talking about. They are the lowest going back to August. I mean, talk about the rally that we've seen as people pour into risk, even though the lower leg in yields that you talk about, Brian, really has to do with weakness. Could we see a material pickup in defaults, or is it just a positioning? Is it just a technical widening in spreads that you're looking for?
No, I think defaults are coming. I don't know that we're going to see that into the next 2 or 3 months. It takes a little bit longer, right? We haven't seen the impact of higher mortgage rates. We haven't seen people have to refinance, a lot of debt yet. So I think defaults are coming, but I think it's a bit more technical. I just think high yield looked great with a 9% return handle on it. When you lower it by a good 100 basis points, 200 basis points, the higher quality assets just look better. So I think the default story is out there. I think the earnings story is out there, but I think it's a bit more technical in the next couple months. Weaker growth. Risk has done too well. People have chased it, and we have to reset.
You said defaults are coming, Brian, but this is one big question mark. How much? Are we going back to sort of a pretty high default cycle, or is it really the consensus that you buy into as well, that it's going to be a relatively low kind of level of default for a longer period of time?
I think the lens people always jump to is 08. I don't think that's the story here, right? I do think balance sheets are okay. I do think there are, there are certainly buckets of consumers that are doing well, or baskets of consumers that are doing well. And so I think we're going to go back up and probably scare the market a bit, go higher than maybe average. But I don't think it might be a longer, drawn out default cycle, but I don't think we have massive default spikes in Armageddon. That's not what's in play here.
I've got to put you on the spot for 23. Is your working assumption COVID zero in China for 2023, Brian?
Such a good question. My working assumption had been before the weekend, yes, and I haven't maybe got enough information to redo it. They definitely want to stick with it. I'm a little less certain now, but I'd still stick with yes.
Brian Weinstein of Morgan Stanley, thank you, sir. As always, I think for a lot of people, if you're sitting around a table wondering whether to press send on your outlook for 2023, I think it's an argument after the events of the weekend, Lisa, maybe to wait a week or maybe wait a couple of weeks.
I would agree with you, except that in a week time, and especially after we get the next inflation report, the next jobs report, you'll be saying that again. I mean, at what point does you have to rewrite it every 10 days, just simply because of how quickly things are moving and the degree of uncertainty?
Just wait until December 15th, the day after the Fed. Just wait until at least then. Does it really make sense until then?
If they waited until after December 15th, we'd all be mocking them. I mean, let's be honest.
No,
we'd be saying, oh, so they're going to wait until the last very second.
I promise. No, I think it makes perfect sense. If you want to wait until December 15th, you get no criticism from me. I don't know what that's worth to you. If it's worth something, if it is, you can wait.
To them.
No criticism whatsoever.
No, I think that you're right. I think that there's so many moving pieces and there's so many key pieces that are going to be determined heading into the year end, where there's typically thin liquidity and other technical issues, which I wonder how much that could set up for a pretty interesting kind of combustible mix.
Brian Weinstein thinks risk has overdone it. We've had a 20% move on the Euro Stoxx 50. Have you seen that?
Yeah.
Off the lows of September, a 20% move in Europe.
How much is that because of not as cold a winter as people thought, stockpiles of energy, of natural gas being higher than expected? And did you see the dollar? I mean, how much is that fueling it too? The dollar is the weakest going back months. I mean, how much can you honestly get this kind of ongoing rally, or is this sort of it in terms of just a repositioning?
European equities bottomed September 29th. The dollar topped 2 days before that. The story's there for all to see.
And you heard all this from people talking about this, that basically where is the value? They go into Europe. I do wonder, though, the European story, how closely is it tied to China? And this is why China is such a pivotal piece. And it's good that you asked Brian that, because how much does a reopening of China help Europe versus hurt Europe by taking natural gas demand out and actually really pressuring on that side of things?
Big question. How was the World Cup banter whilst I was away?
Oh, I was dreadful. Tom did his best, but I was pretty dreadful. He did his best. I will say I actually watched the World Cup all weekend. It was great.
Wonderful.
Really good soccer.
I'm pleased you're engaged. That's great.
Did you hear about that? The U.S. versus England?
I did,
It's called soccer.
That's fine. I'm not. That's fine. I'm pleased that America is engaged with the world's sport.
What are you, a diplomat?
So diplomatic. Yeah. No one
endlessly
thinks I'm diplomatic. Futures on the S&P down 0.75%. In the next hour, Michael Purvis of Toolback, and looking forward to that conversation. Dan Ives of Wedbush is coming up later as well on Apple. And next on this program, we'll catch up with Ender Curran in Hong Kong on the latest in China. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, protests against COVID restrictions are spreading. Citizens took to the streets and university campuses and vented their frustrations on local officials and the Communist Party. Huge crowds gathered in Shanghai, where some called on President Xi Jinping to step down. That's a level of defiance unheard of since Xi took power a decade ago. The price of oil has fallen to its lowest level in almost a year. The protests in China clouded the outlook for energy demand. West Texas Intermediate fell below $74 a barrel following 3 weeks of losses. The unrest helped the dollar as a haven, which made raw materials less attractive. Retailers in the U.S. saw modest growth over the Black Friday weekend. According to data compiled by Sensormatic Solutions, in-store traffic ticked up 2.9% at brick-and-mortar retailers over 2021. Deep discounts lured in shoppers that were looking for a break from inflation. Turmoil at Apple's key manufacturing hub in China will be costly. Bloomberg's learned that the unrest is likely to result in production shortfall of close to 6 million iPhone Pro units this year. The company that operates the facility, Foxconn, is trying to get workers back to assembly lines after violent protests against COVID restrictions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
it's clear to me that Xi cannot tolerate any protests. So there will be a very tough crackdown on any protesters. More people will be arrested, and they will probably go further in terms of control.
Waiting to see what the response will be. That was Mark Mobius there, Mobius Capital Partners, founding partner on Bloomberg TV a little bit earlier on. From New York this morning, good morning. Equities are lower on the S&P 500 off the back of some of that unrest in China. We're down about 0.75% on the S&P. Euro stronger, 104.88. We're positive there by 0.9%, creeping closer and closer to 105. Yield's not doing much on a 10-year, 368.49. Later this week, it's payrolls on Friday. Then on Wednesday, you hear from Chairman Powell. The events of the weekend, just dominated by concerns about unrest in China. How's this for colour, Lisa? CCTV in China appears to be cutting footage of maskless World Cup football fans in Qatar, cutting away from the scenes of maskless fans at the World Cup.
How much is that just showing what we're seeing and how significant it is? And the fact that this is actually being aired, that to me is notable. This is actually getting out there. The politicians have to respond.
Let's see how they respond. Enda Curran joins us now, the Bloomberg Chief Asia Economics Correspondent. Enda, I want to start here and broad and help us if you can. What marks the difference here between what we've seen over the weekend and what we've seen in years gone by?
So these are unprecedented, John, in recent years because of the number of cities that they're occurring in at the same time, their breadth, and the fact that they are protests against government policy, a uniform protest against government policy. Now, sporadic protests in the past in China have not been unusual. They've been against perhaps a local environmental policy, the location perhaps of a landfill site, for example, these kind of things. These protests come and go, but these are unusual because you're talking about the far west of China, you're talking about Beijing, Shanghai, Guangzhou, next door to us here tonight. All of these over the weekend have had protests, all pushing back against the Communist Party, very explicit commentary against President Xi Jinping, and it speaks to the level of frustration, of course, and fatigue on the ground. We often talk on this program, on your program, about how do we know what a sentiment in China is like. Well, now we're getting a real glimpse of it via social media. Obviously, it's being heavily censored, but enough is leaking out to let the rest of the world know that there is a lot of fatigue and frustration in China right now.
And when you talk about how a lot of it's being censored, I think of those blank sheets of paper that they're holding up to signify that they are being censored. Others sometimes having the circle with the exclamation point in it to signal that something has been retracted or isn't available. How much is it unusual that this is getting out in the way that it is, even though, yes, it is significant, but normally, wouldn't the Communist Party crack down more significantly?
Well, it's interesting. So two things are going on. On the ground, some experts I've heard say are making the point that so far the government are allowing these protests to some extent, that they're allowing these people to vent clearly by allowing these gatherings of maybe hundreds or thousands, depending on which city you're talking about. So there's an element of that going on. Social media, though, is being heavily controlled, and I think the fact that so much is leaking through speaks to the volume of protests that's being aired on social media and the volume of discontent. So clearly the government is struggling to keep a lid on what is leaking out. But the big question, though, is what will the response be going forward? A lot of experts are saying, of course, there's going to be a government response, likely through the police, through the typical response of mass arrests and crackdown on these protests. And will that be enough to keep a lid on it? I think that's the big question going forward. The government's unlikely to materially pivot on COVID just in response to the protesters, but there is a view that this might accelerate the path that they're on to get out of this position that they're in, which is going to be clearly a very complicated and I think damaging path for the economy in China.
And what's the main holding point for China to not go and say goodbye to the zero COVID policy?
A public health disaster remains number one. I mean, obviously there have been some political bragging rights. The Communist Party and President Xi Jinping has enjoyed the point that look how we've handled COVID versus the Western world. But leave aside the politics of it, several experts make the point that China's hospital network is not up to what's needed to deal with a mass outbreak of Omicron. And Omicron, of course, is what the big game changer in all of this. And then you have the Achilles heel, which is the vaccine coverage of the elderly. Now, China's homegrown vaccines have been shown to be perfectly effective and safe, not as effective as mRNA, but effective. But the big problem is the coverage of the elderly in terms of getting their vaccine and getting their booster shots. We're going obviously into those deep winter months now. This is a key vulnerability for the Chinese economy. And this is what the biggest concern is, I think, for most people looking in on China. How are they going to get that right, and what will it mean for the hospital network?
Andrew, it's a mystery to me as to why we had stronger vaccine mandates in the West and not in China. And it's a mystery to other people as well. And why is that the case?
It's a very fair question, John. A lot of people do raise the point with the political system and the control that China has in place. Why haven't they been targeting the elderly? There is a response that it's perfectly rational that if you live in a country where you don't have COVID, why would you get vaccinated? But of course, the Western world or the outside world would say, ultimately, COVID zero is unsustainable. There will always be a leak, and Hong Kong is exhibit A for that. It's a very same set of circumstances. We had 2 years without COVID, but we had an elderly population that were not vaccinated. There were plenty of warnings. This is not sustainable. Ultimately, the disease will arrive. It did arrive. It spread rapidly this year, as we know, and we had very serious fatality rate among the elderly. And a lot of people are pointing to Hong Kong as a key warning for the risks that China is now facing.
And wonderful to catch up with you, sir. Thanks for staying late into the evening for us out of Hong Kong. And Karen there. Bramo, we're not the only people asking that question. Many people just think it's absolutely bizarre, totally bizarre.
If the public health concern is the main concern for why you're not going to end COVID zero, why not expedite some kind of vaccination progress in the weakest links and the people who are the most vulnerable?
It's not for me to say what they should do from a policy response. But sitting here, I'm just saying it's strange that we saw a stronger push for vaccine mandates in the West than what we're seeing in China. That just seems very, very odd.
There are a lot of questions, and I will be delegate here, about the consistency of the public health concerns with COVID zero and how it's being enforced. And that is probably underpinning some of these protests, especially in light of the footage of fires and people and firefighters not being able to get to the citizens because of the iron gates put around their communities to enforce COVID zero. It is a question around public health that cannot be answered when it is so inconsistent. And it has been inconsistent all over the world, don't get me wrong.
Sure.
But China has been the outlier in terms of how long it takes until they can really exit this.
One US official outspoken on all of this over the weekend, the president's response coordinator for the pandemic, speaking on ABC's This Week on Sunday, quote, "It's going to be very, very difficult for China to be able to contain this through their zero COVID strategy." That individual went on to say, "I would recommend that they pursue the strategy, making sure everybody gets vaccinated, particularly the elderly. That, I think, is the path out of the virus. Lockdowns and zero COVID is going to be very difficult to sustain." Let's see if they try to sustain it.
I mean, that's kind of true, right? I mean, it's been proven to be true in terms of it is difficult to sustain. They continue playing whack-a-mole with different outcroppings of COVID. They're going to continue with this. I just wonder how much we're going to end up with a situation where this is positive for the global economy or negative in terms of the inflationary shock.
Futures negative 0.75% on the S&P 500. Coming up next, looking forward to catching up with Dean Kernert, the founder and CEO of Macro Risk Advisors from New York City. Heard on radio, seen on TV. This is Bloomberg.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
I love the feedback I get on this program. Johnny boy, I think you need to go Mobius and rock a white suit on air sometime this week. How do you think that's going to work out? A white suit. If TK goes beige and I go white suit, I think that would work.
What color tie would you wear?
With the white suit?
Yeah.
What color tie do you wear with the white suit?
I think that you would have to...
What does
I think
Mobius do?
I think it would have to be like a tan kind of paisley, which I can't imagine at all you're ever wearing. I think that you'd have to
Please the camera didn't pick up my face then. Equity futures on the S&P look like this. We're down by about 0.8% on the S&P. On the Nasdaq 100, we're down by 0.9%. On the Russell, the small caps lower by 0.75%. Apple, the stock to watch, is down by about 1.8%. Bramo will talk about that a little bit later. Our reporting this morning is the turmoil at Apple's key manufacturing hub in China likely to result in a production shortfall of close to 6 million iPhone Pro units this year. As I say, we'll pick up on that a little bit later. In the bond market, 2s, 10s and 30s look like this. The 2-year backing away from the highs of the year over the last few weeks. 446.29 on a 2-year, going into Chairman Powell on Wednesday and payrolls on Friday. The 10-year basically unchanged this morning at 368.12. The curve deeply inverted. In the FX market, euro dollar the standout. Yen strength out there too. So dollar weakness the theme of G10. Euro dollar right now pushing 105 at 104.87, positive 0.9%. We've talked about the Fed speak. Bramo mentioned the ECB speak, and I think this line, I'm with you, from Klassenot of the Dutch Central Bank. He called any talk of over-tightening at this point, quote, a bit of a joke. Now, the thing that I have with this, Lisa, is that many people don't think it's a joke.
No.
I think it's a very real conversation based on where the growth picture, the backdrop's going to be in Europe going into year end.
And the reason why I think that a lot of people don't view it as a joke is because of something that Torsten Slok of Apollo put out over the past couple of days, where he was talking about recent reports putting only a third of the inflation that we're seeing due to demand side issues. The rest are supply side issues. So if you crimp demand, it doesn't even necessarily affect inflation as much as people previously expected. So in other words, if you tighten all you want, it could affect a third of the inflationary picture. It isn't the main input, which is the reason why some people say perhaps you're using a blunt instrument for a very different problem this time around.
So Philip Lane of the ECB has written extensively on this, and he did so recently in a speech. What's interesting, though, even though he comes to the same conclusion, ultimately, he thinks the risk is inflation expectations, and you've got to do something about it, so you've got to keep on hiking. I'm pleased you brought up Torsten Slok, because over the last few weeks, he's made a very, very important point, comparing Europe to, say, the United States, and it's the sequencing of the downturn. The idea being that in Europe, you're getting a downturn in the economy before you get a peak in inflation. And in America, maybe you're getting a peak in inflation before you get the downturn in the economy. And clearly, the latter is far more favourable than the former for a policymaker right now. And I think for the Europeans, for the ECB, tremendously difficult position to be in, to be hiking interest rates before seeing a peak in inflation. They're witnessing this economy roll over.
They're between a rock and a hard place. I don't envy the ECB. I don't think that anybody does. They don't have the tools to really respond to something that's an energy-driven crisis, that's really a supply-driven crisis. It isn't necessarily the same kind of demand, although there is that as well, partly coming from the U.S. I don't know how they get themselves out of this, but I want to hear from Christine Lagarde, because is she going to basically reiterate what Klaus Knott said, which is, we're not even close. We're going to keep hiking.
Does Lagarde speak every week? It feels that way.
Well, I mean, she's got to keep up with the Fed.
Every single week. We don't hear from Chairman Powell that often.
Yeah, but he's trying. He's speaking Wednesday, so we'll see.
We'll hear from him later. You've been diplomatic this morning. Good for you.
Anytime.
Dean Kernet, founder and CEO of Macro Risk Advisors. Tom would have gone for that.
Yeah, he would.
You know, he would have had a good dig.
Uh-huh.
Dean, thanks for being with us, sir. What do you make of the rally we've seen over the last month? And after we heard from Brian Weinstein of Morgan Stanley about 20 minutes ago, he turned around to us and said he'd fade this. He thinks we've overdone it. Do you agree?
I would probably be more in that camp than the other camp. But just go back to CPI day, a 5.4% move in the S&P. it's sort of the upshock heard around the world. And if you just look at the import of that day and just look at all of the cross-asset indicators, whether it's the decline in rates, the decline in volatility, the significant decline in the dollar, I think the good news for that day is that we moved away from the cliff. We were headed towards a cliff event, specifically with respect to how tight the dollar was imposing itself on the sort of system of pricing of risks. So we moved away. The last 10 days in the S&P have been super quiet, and we're kind of in this holding pattern right now. And what I mean by that is we're obviously waiting for Powell on Wednesday, and then we've got this twin terror events, especially if you're short volatility on December 13th and 14th. I can't remember a time when the CPI and FOMC were on top of each other like this, just given how substantial these days are. So, John, as you know, we focus on volatility at Macro Risk Advisors. The VIX is down around 20. I'd like to say we're pretty close to a floor in that. I don't know that it's going to spike tomorrow, but I think we've settled into a level where the folks that are being asked to sell volatility are going to have a harder time letting it go at this price. There's not a lot of room for error down around 20 in the VIX from here.
Well, you are really famous for saying that transitory is a new subprime is contained. And you said that on this program months ago. Are we there yet when it comes to rolling over inflation? And even if we do see some kind of spike up in volatility, it isn't going to cause some sort of meltdown because we are starting to peak out and roll over.
Yeah, we're all subject to the data. And I think that at least recently, the data has been cooperative in a way that you might be able to start. You can kind of see the path from here. There's so much market conversation around December is 50. We're sort of locked in on that. That's a deceleration from 75. That's a big deal. Even just being able to get the Fed to 50, and then maybe you do a couple of 25s in the early part. And that policy rate, the forward policy rate, peaks as early as March. So you can kind of see forward here. And a lot of that is that if you won't hear this from the Republicans because they'll be stuck on year over year, as they should be in terms of the political fight. But over the last 3 months, your inflation's sort of annualizing 3.5%. So you're getting closer. I think the question then is going to become, and again, this is why this is going to just take so long, is if you're in the 3.5% zone, are you really committed to getting to 2? And Lisa, as you were referring to, if higher rates are your instrument to get you to 2, and getting to 2 is really less about demand, it's more about supply that higher rates doesn't affect, well, then you really might be, putting a lot of downward pressure on risk assets. So it's going to be a long period of time here. I certainly think you're supposed to watch the yield curve inverted by, take your pick 75 on 2s, 10s. But if you look at the forward policy rate versus where 10s are now, you could invert out to March by 125 basis points. That's pretty deeply inverted. And I think it's the market telling you something that the Fed may be vulnerable to going too far here.
Brian Weinstein agreed with you. He basically was talking about a similar type of inversion and sees the potential for 10-year Treasury yields to go to 3.25% at some point in this next leg of a rally. Have we reached a pivot point, an inflection point, where yields can go lower and stocks can go lower, where bad news is bad news, and we're really entering that phase in a more sustained way?
Yeah, I think that's exactly the narrative that I think is applicable here, which is these taper tantrum type episodes where rates are the impetus for stocks falling, higher rates, lower stock prices. That's a correlation we're not used to. I think they typically end with a more classic risk on, risk off, and that is lower rates, lower stock prices. So I personally think that's ultimately where we're going. It's very, very difficult for the Fed to land the plane here successfully, and for risk assets, let's just use the S&P to do fine from here without the Fed over tightening. So I do think that there's a potential that you'll ultimately see more of this sort of classic stocks down, rates down type of scenario. And look, we're supposed to try to find portfolio additions that are less correlated to risk assets. So what's been correlated? Well, obviously the bond market and the stock market have had almost a record positive correlation. Stocks and the dollar, that correlation has been incredibly strong, in a way that just doesn't lead to favorable diversification. So one of the areas that I think you're supposed to look at, especially as digital gold has blown up, Bitcoin has blown up, is to look at gold itself. Gold and the S&P, they have a strange relationship. They're correlated sometimes. They're recently very correlated because they're both negatively correlated to the dollar. But I do think that there's an opportunity here to, as you build your portfolio out and you try to find those lower correlated items in the portfolio, I think that gold has got the potential to do well in what I think is coming, which is a classic risk-off. Stocks down, rates down. That's a scenario where gold can do quite well. And if you look at the options market, the upside calls on gold are quite cheap. That's the implied volatility is as low as it's been since the start of the pandemic. So that's a conversation we're having with clients right now.
Gold up this morning by a third of 1%. Dean, awesome as always. Dean Kerner there of Macro Risk Advisors. That was Dean in the summer of 2021, you know. The transitory as the new subprime is contained. Summer of 21, what a call by him. And many others as well.
So now what do you do, given that you expect it to roll over by perhaps the first quarter of next year or second quarter of next year, which is exactly what he's talking about? All of a sudden, we're in a new inflection point. And we've been talking about how trend following is suddenly shifting and churning, and there isn't this clear trend the way there was for the past few months, because we're entering something new where yields can go lower and stocks can go lower at the same time.
2's 10s, negative 78. That's kind of crazy, isn't it, to see that number on the screen?
It's even crazier to think that we're going to 100, negative 100, negative 125. And we heard
Brian's right, yeah.
Brian and Dean Kernet, they both agreed on this. I don't see another out, because if you look at the idea of a rally in 10 years, which is the reason why people say this is a safe haven, and you still think that the Fed's going to hold rates at a higher level than where we are right now, it makes sense.
We've sold the white suit dilemma, if you're interesting.
I know, I saw that.
Jerry Ad on Twitter. Thank you, Jerry. Just go full on Travolta, black shirt, no tie. That's how you get around this.
Well, I actually did some research also because I figured that I needed to have a better answer
What
for
does
you.
Mobius do? What does Mark do?
That's exactly right.
Isn't it a yellow tie?
He does a yellow tie. He also does a bright blue, a light blue tie. I think it's really see rocking that. There's others where he does not wear a tie. I think that you could rock that look. And then there's a black tie, yellow tie. He has all sorts of ties. I think you've got lots of variety.
Google image this.
100%.
I'm not going anywhere near the white suit.
No kidding. I figured, though, I would just, provide a little insight other than
It's a hard pass from me.
I know.
Coming up, and that's not me taking a dick at Mark Mobius, of course. I think his suits are great. Coming up, Ellen Wald, Senior Fellow at the Atlantic Council from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A sense of uncertainty sweeping through Chinese markets as protests against the government and its COVID-0 strategy complicates its path to economic reopening. Goldman Sachs economists said they see a chance of a disorderly COVID-0 exit. Demonstrations across various cities and universities in China were fueled by a deadly high-rise apartment fire in Urumqi. Now that some blame that virus restrictions hampered rescue efforts there. Republicans say they'll demand greater oversight of U.S. military aid to Ukraine when they take over the House. Representative Michael McCall told ABC News that there will be more transparency and accountability. McCall also said he supports sending Ukraine long-range weapons to defend against Russia. Federal Reserve Chair Jerome Powell is expected this week to set the stage for slowing interest rate hikes. At the same time, he'll remind Americans that the fight against inflation will run into 2023. Powell will make a speech on Wednesday, one of the last from policymakers before the Fed's meeting December 13th and 14th. And after cutting thousands of jobs, Twitter now hiring. That's according to slides from a company talk tweeted by owner Elon Musk. The first slide had the words, "We're recruiting," with no further details. The slides also said that new user signups are at an all-time high, averaging over 2 million a day in the second week of November. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative.
It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
We're in the early stages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
This full reopening, as I mentioned, is to us more of an H2 story. I think in the near term, it seems to be more of a drag on oil than anything.
Christian Muller-Glissman there of Goldman Sachs weighing in on the situation in the commodity market. Live from New York City this morning. Good morning. What a trip it's been through the month of November on crude. The highs of the month in November on WTI came on November 7th. We came close to 94. Since then, we're down by more than 20%. So from the low 90s, Bramo, to the low 70s in what, 3 weeks?
And why? The real question is the why.
Have you got the why?
People saying that perhaps the economy is going to slow down to such an extent that it will reduce demand. Other people speculating that more oil is going to come on. I'm not understanding the why. I just can't get my hands around why.
So let's go to the story of the weekend, and I'll get your thoughts on that as well. So we understand the Biden administration has granted Chevron a license to resume oil production in Venezuela. I think many people saw this coming. After US sanctions halted all drilling activities for much of the last 3 years, I think we're all asking the same question. How much of a change is this?
We don't know the answers to that. What we do know is that a lot of Western nations are going around the world figuring out who the less bad players are for them to source some of their fossil fuels, some of their natural gas, who they can rely on over the short term, over the longer term. And those alliances are getting redrawn. The power lines are getting redrawn. How do they shake out? We don't know yet.
Alan Wald joins us now, Senior Fellow at the Atlantic Council. And I'd love to start there. Just the latest move from this administration for Chevron around the story in Venezuela. What are your thoughts on that? Are we still too light on detail for you to draw too many conclusions?
You know, I do think that we're short on detail here in terms of the Chevron story. So, for example, is this oil that's already on the market just on the black market? or is production actually going to increase in Venezuela, in which case that could be meaningful for the market, but probably is going to take quite a long time to actually get going, because their oil facilities have been in incredible disrepair. I mean, this has been a very, very long problem for them. The interesting thing, though, is we say that where they're looking for oil producers that are less bad. There are a lot of less bad oil producers in the United States that have the ability to produce more, just they aren't producing more because they don't think that the atmosphere is conducive towards it, and also that they're facing a lot of headwinds from inflation and having trouble getting parts and getting labor and getting equipment, and costs are very high. But there are definitely things the Biden administration could do to encourage those less bad oil producers in our own country.
Ellen, then why are oil prices so low? Is this something that completely is a demand-side story that we're seeing play out, or is it just the imagination of a demand-side story that is yet to play out?
So I do think that it is somewhat of an imagination of a demand side story, because you do have a situation where I think futures trading is impacting the prices now, and the future of oil is very, very hazy right now. What's interesting, though, is that the fact that prices are kind of low now could actually spur more European utilities to switch from natural gas to oil, and that could then later kind of send a bump into oil prices. So I think that just because we're seeing kind of a lull or a period of lower prices now, we shouldn't expect that that's necessarily going to continue. There's always a tendency to think that what's happening now is what's going to happen for the rest of the winter. And I think that with what we've seen certainly in the past with the incredible volatility here, is that we cannot underestimate the effect, and we could see a very, very quick rebound if we're not careful and paying attention.
Ellen, the big news over the weekend was the social unrest in China, the possibility of perhaps a quicker exit to zero COVID on the heels of protests around the nation. Do you view the unrest that we're seeing over in China as being potentially a logical reason for oil prices to be lower, or would you expect that to actually send oil prices higher because of what it might mean for zero COVID?
Exactly. So I do think that earlier in the week, that China's COVID policies, continued lockdowns, things like that, definitely helped send oil prices lower. So if we're talking about, say, the beginning of last week. And the question is, what do these protests actually mean? I'm not a China expert, but if you do look at China's history, the regime there has not been particularly responsive to protests. They also don't seem to really have a problem with lots of people dying in pursuit of their policies. So just the fact that there are protests in China, I think it means we should pay attention to it, but I wouldn't necessarily put my money on it having a widespread impact or a big change or shift in the Chinese regime's policy particularly quickly.
You are an OPEC expert, so let's build on some of that knowledge if we can. I'm interested in the working assumptions for next year. Is OPEC looking at a 2023 where COVID zero is still implemented by the Chinese government? Is that the working underlying assumption of that organization?
That's a really good question. And I think that I do think that if anyone is going to know first, it's probably going to be Saudi Arabia, because they've got a very close relationship with China, with the Chinese government. They've got lots of oil investments there. Aramco has tons of refineries. They've got long-term contracts for crude. And if anyone is going to have a sense of when China is going to need more crude oil, I do think it would be Saudi Arabia. So if Saudi Arabia is sending signals that they don't think oil demand is going to increase very much over the course of the winter, then that could be an indication of China's COVID policy.
And well, thank you of the Atlantic Council on the latest in the crude market from Venezuela to China, trying to work out 2023.